Okay, good morning everybody and welcome to today's mini mentorship course with myself, Gavin Holmes. For those of you that don't know me, I'm the author of a book called Trading in the Shadow of the Smart Money. Now, we've decided once or twice a month to put on these special 3-hour courses to cover some of the questions that we get asked regularly in our VSA club or in our Trading the Market service. And so today I want to really talk about some of the key principles that move the markets. And in fact, last week we saw a very key principle appear on the S&P, the E-mini S&P, when supply began to come into the market, causing the market to then become weak and fall. And in fact, exactly the same setup happened on the Australian dollar. And what I'm going to show you today, well, let me tell you what we're going to talk about today. So we all know, most of us, I'm sure, what is volume spread analysis, okay, because many of you here are long-standing customers. I will cover a few basics, but we're going to get into some more advanced stuff today. Now, specifically, we're going to talk about identifying no demand bars. Now, when we see no demand, they happen in 3 places. By the way, if you've got a pen and paper, you might find it helpful today to take some notes, because some of the things I'm going to, okay, it's all going to be recorded, it's all going to be archived, but there'll be a lot of information here, so it might be helpful for you to take some notes. So we're going to talk about no demand. This is a very strong signal to short the market, but only when it's in the right place. Now, we see no demand bars in 3 different places on a chart. In fact, probably 4 actually. We see no demand bars in uptrends. We see no demand bars at market tops. We see no demand bars in downtrends. And we see no demand bars in whipsawing markets. Let me ask you all a question. Where do you think the best place to short a no demand bar is out of those 4 scenarios? Where would you think the best place to go short on a no demand signal is? Okay, I'm just looking. Most of you are getting this right. The answer is the best place, or the safest place to short this, is in a downtrend. But, as I'll show you, give you 2 examples, you do get no demand bars at the market tops. And if you're a counter trend trader and you're quite happy to go short against a trend, I'm going to show you the signal where if you see no demand after this signal, you go short, regardless of the fact that it's been trending up maybe for years. We call that signal the end of a rising market. It's my favorite. I'm going to spend quite a lot of time today explaining the short setup on that. I managed to short gold last year on the basis of this setup I'm going to show you. And I've been a bear on gold for 2 years, despite most of the TV analysts telling us that gold was bullish and Goldman Sachs raising their forecasts. I was on YouTube warning the public they were being groomed into a really bad trade if they bought gold. Of course, that's now been proven. We had our biggest 30-year fall in gold in April, and there's been some wonderful shorts, and there will be more. So we're also going to talk about something I don't spend a lot of time on, actually, but it's a great setup. It's called no supply, and it's the exact opposite of no demand. Okay, now let me just, before we move on, clarify what no demand is. It basically means there's no interest in higher prices from professional money. Everything I'm going to talk about today is all about tracking what we call the smart money. The smart money are traders or syndicates or hedge funds or large individuals with large accounts who think nothing of putting 50,000 contracts into the market at any one time. These syndicates, these institutional banks exist. You better believe it. They move the market. And if you can follow their footprints and see when they're interested in buying and when they're not interested in selling, you can start to read a chart. And that's what today's session is all about. Chart reading skills. Looking at each bar in relative terms to what's going on in the background to see if you can identify strength or weakness. Now, we're also going to talk about Tom Williams and my favourite signal to go long. It's called bag holding. It's a very strong setup to go long. Now, you don't see this very, very often, but when you do, you can start to get excited because you're going to make some money on this signal. I'd be very surprised. You'd have to be a very poor trader not to be able to be successful trading that indicator. Now, with the end of a rising market and bag holding, both of these signals will appear on ultra high volume. Ultra high volume. And the spread of the bar, as we're going to see, will be narrow. That's the key to it. So with any VSA principle, the strongest principles, meaning the ones that are going to turn the market, appear when the volume is at the highest, usually higher than the last 50 bars, and the spread of the bar is narrow, at a narrow range, and we have a close that's in the middle or near the low. What that tells you for the end of a rising market, as we'll see, is something is putting a lid or capping the top of the market. Now, bag holding is the exact opposite. It's professional money buying, not selling. They're buying into all this news. And usually the news will be bad. And in fact, when I first met Tom Williams, he showed me a chart, the chart of just after the 9/11 attacks on the World Trade Center. And he said, what do you think happened to the market? I said, well, it collapsed, Tom. The market was closed for 4 days. It was historic, and it was unprecedented. I said, and then the market turned bearish. And he said, no, Gavin, that's not what happened. And I looked at him and he showed me the chart. And there was one of his signals on the daily chart, bag holding. Volume was absolutely enormous. Narrow spread, closed in the middle. And then for the following 12 weeks, we had a rally. After this absolutely catastrophic event, the market actually rallied after that. So it opened down, it gapped down. But professional money saw an opportunity to buy at much lower prices. And they did. And we call it bag holding. And the reason is, as Tom explained to me, he said if they were telling you the truth on the exchange floor, when they were interviewed, they would have said, yes, there's been terrible news. President Bush has been on television saying Al-Qaeda networks could be all over America. And today the stock prices have plummeted. People are getting out of the stocks because there's uncertainty and fear around. But if they told you the whole truth, they'd have then said, but don't worry. The professional money on the floor of the exchange know full well that those stocks that were valued at X on the 10th of September are now here on the 16th of September, 30% lower in price. They're a bargain, so we're going to buy them. And they open up their bags. And I'm not showing a chart at the moment, Gary. I'm going to show the chart. Don't worry. You're going to see all the principles, some of them live, some of them in PowerPoints. But I just want you to understand the psychology first of these two signals. Now, the end of a rising market, the psychology is the opposite. Instead of all bad news around, there will be good news. There will be forecasting higher prices in the immediate future. I'll give you an example. The example I'm going to show you today is gold. In fact, we found that Goldman Sachs, on the day they put out their gold forecast in 2011, that gold was going to go up to 2,500 a troy ounce, they were actually selling. So you've got to be very careful if you're a fundamental analyst and you use fundamentals. A fundamental analyst and you use fundamentals. You've got to be very careful where you get your fundamental analysis from, because often it's within the bank's interests to make sure they have a willing buyer. And if they bought gold at 1,000 and they're now able to sell it at 1,900, wouldn't you? That's good business. But it's not, when you see the signal, you'll understand why the end of a rising market is a place to short almost immediately. But in the example I'm going to show you how no demand confirms what we saw on the end of a rising market. Now, there are certain places where there's no permission to trade using VSA. Today, several examples of where, based on my trading plan, which I'm going to give you all a copy of, by the way, at the end, you're going to get a copy of my personal trading plan. I actually have situations where if the trends are not aligning in 3 time frames, I can't trade. I've got no permission to trade. Now, on Friday, in the Australian dollar, after we had this big markup from the FOMC meeting minutes, they came out and said, we're not going to do taper off now. We're going to continue printing money because the market was marked up artificially. So it was a great opportunity to short the Australian dollar. And every single time frame that I use, and I use 4, was all red, basically saying short it. And the short came on a 15-minute chart on a no demand bar. And of course it had to work because there was weakness, as I'm going to show you in the background. Now, most people would love to know how to identify a market top and a market bottom. Well, I'll show you it right now, how we do that. Okay? But before we go to the chart, let me just refresh your memory. And I hope most of you already know this, but what is VSA? Now, most of you will be aware of the 2 widely known approaches used to analyze a market. That's the fundamental analysis and technical analysis. Many different methods can be used in each approach, but generally speaking, fundamentals is concerned with the question of why something in the market will happen. And technical analysis attempts to answer the question of when something will happen. Volume spread analysis, however, is a third approach to analysing a market. It combines the best of both fundamental and technical analysis into a singular approach that answers both questions of why and when simultaneously, as I'll show you today. So at its core, VSA is a method based on the original works and teachings of Richard Wyckoff. Let me just ask you a question. I hope it's a stupid question, but I'll ask it anyway. How many of you here have heard of Richard Wyckoff? You know who he is. He's obviously passed away now, but he was a trader in the 1900s. I'm assuming you all know who Wyckoff is. Yep, my mate, says Andrew. He's all our mates. Yep, he's the guy that really wanted to help the public to understand the bucket shops, as he used to call them. And the methodology that Wyckoff taught is actually still taught today at the Golden Gate University in San Francisco. And there's a very interesting article. In fact, I might even post it in the room for you to go and have a look at. We'll do that at the break. And it's an article written in Business Insider magazine, and it says the Wyckoff method is the trading method that hedge fund managers don't want the public to know about. I'll send you the article. Very good article. Now, it's interesting to note that VSA is all based on the principles of Richard Wyckoff. And it's all based around universal forces that drive the markets. So everything that we teach is actually not rocket science at all. It can appear to be rocket science at first, but it's all based on logic. The methodology that we teach seeks to establish the cause of the price movement on a chart. But the cause is simply the imbalance of supply and demand as the market trades, which results in strength or weakness in the market that's being charted. So did Wyckoff study Gann? Wyckoff did, I believe, study Gann. Yes, Anthony. And he also used waves very effectively. And I use something called the Weiss wave, which is very similar to what Wyckoff used to measure the different number of contracts that are being traded at different price levels. But we're going to keep it a bit more simple than that today. I'm not going to try and introduce you to lots of different concepts. I want to keep today all about the core principles, because that's what you're going to, that's how I learned. And that's, once I knew these principles inside out, then I could add 1 or 2 things to my trading, which made a big difference. But I already knew that Tom Williams, who taught me, was telling me the truth about the markets, because when he showed me the chart after 9/11, and then you only have to look at the gold chart, which I'll show you in a minute, you can clearly see how the markets are moved by very high volume followed by very low volume. Now remember, for the correct analysis of volume, you need to understand that the recorded volume contains only half the knowledge required for a correct analysis. The other half of the knowledge is found when observing the spread or the range of the price bar and the closing price on that bar. Now, what we don't tell people is that volume spread analysis doesn't just analyze one bar. It often analyses 2 or 3 before producing a signal. We'll often hear us use the word confirmation. Everything in VSA requires confirmation. So just because you see a massive volume up bar with the next bar closing lower does not mean at that point you want to go short. And a lot of people unfortunately get caught with that, because you can make money shorting every high volume spike that you see. But the problem is you will get caught out, because there are times when the professional money mark the price up, test it, and then the market goes up more because they're still bullish. So we always want to use confirmation. So although we can see that volume tells us something, the other half of the knowledge is found when observing the spread or the range of the price bar and then the closing price on that bar. Remember, this is really important, this bit, volume indicates the amount of activity on the price bar, and the spread or range of the bar shows what the price actually did, and most importantly, where the price closed. So let's get the basic bit out of the way quickly here. I hope you all know that VSA, as we call it, is analysing volume. We specifically look for ultra high volume and ultra low volume. That's really the 2 key things we're looking for in a certain number of price bars. The spread of the bar is simply the high and the low of the bar. And then we have what we call the closing price. Now, we don't use the opening. Does anyone have any ideas why Trade Guider does not analyse the open of the bar? Anyone can think, why do we not analyse the open? Andrew says because there's gaps. That's naturally not it, but it doesn't help because it can be misleading. Gregory just said it, because nothing's happened yet. That's right. Well, let me give you the answer to that. As I'm going to show you, the markets move on universal laws. Just like you're sitting there or standing there now, wherever you're doing, you're not floating off into space, because at this moment in time, you're hit there, or I'm here because of gravity. It's a universal force. We accept it like we accept the force of electricity. Now, if I asked you to explain the force of gravity to me, you might, unless you're a physicist, you might have some trouble. Now, there are universal forces at work in the markets, and there are universal forces at work at every single millisecond of the day and night. But when you understand them, one of the universal laws that we study is the law of effort versus result. Now, the key word there is result. On the opening price of a bar, you've got no result. You don't even see what the effort is. And the analogy that Tom gave me, he said, Gavin, when I first met Tom, I employed about 35 people in one of my businesses. And he said, Gavin, are you interested when you get in first thing in the morning at 9 o'clock and the team have been in for 10 minutes, they've had a cup of coffee, do you then call them all in and say, hey, what have you been doing the last 10 minutes? It's irrelevant to you. They haven't started their working day yet. However, at 5:30, do you want to call them all in and say, hey, how did you do today? Because I can see you've been here for nearly 9 hours. I can see that you've done X, Y, Z today. So I can see that you've put in a lot of effort and you've achieved a result. Exactly the same with a chart. The effort's in the volume. We don't see the result of all the effort until the price closes. And the price can close in various places on the bar, and it's all relevant. It can close on the top, it can close on the bottom, it can close in the middle. All of it's relevant. But what's even more relevant is what happens to the very next bar, as I'm going to show you. That's a big clue as to what professional money are doing and what they're setting up. So the markets work, and they work very efficiently, because of human beings and because of our emotions. The 2 strongest ones are fear and greed. Now, as Tom taught me, the market has to be fed losers. He always taught me the market's not there for your benefit, Gavin. But it's not like gambling. If you can put the odds in your favor by reading the chart, you can become a professional trader and investor who understands the underlying reason for price movement. And when we look at a price bar, we're looking at the activity on that bar. Okay, we're looking at the activity on that bar. The activity is simply volume. And volume tells us if professional money, big players, are becoming very, very active or very, very inactive. And then if we look at the spread of the bar and the closing price, it tells us on that volume what their true intention was at that price level. But most traders who start off in trading and never used volume will use past price analysis to try to get a signal to buy or sell. Now that is dangerous because it's not the past price that is moving the future price. It's the trading of the professional money, as I'm going to show you. Before we start getting into the key principles, I am going to talk about accumulation and distribution. Okay, but remember, the past price does not cause the future price to move. The price movement is caused by the activity, either the buying or selling of smart money. This cannot be seen by just analysing past price. It's vital to look at more than one time frame on any chart and to look very closely at volume, as we will now see. Now, one of the things you'll notice about when I trade is I look at more than one time frame. And what I'm looking for in more than one time frame is alignment of trend. That's it. I'm not really looking for different principles in different time frames because it's very common to have a sign of weakness on a 4-hour chart and the market begins to fall, and then a sign of strength on the 5-minute chart and the market begins to rise. So which one's right? The 5-minute or the 4-hour? They're both right. The market is constantly moving because of the imbalances of supply and demand. So it's very common for the market to be trending down on a 4-hour time frame, but trending up on a 5-minute, 15-minute and 60-minute time frame. So what I look for in my 4 time frames, I want at least 3 to be going in the same direction, and I'll trade in that direction. And as long as you stick with that rule, you very rarely come unstuck because you're trading with the river. If you jump into a fast-flowing river and you try and swim against the current, A, you're going to become very tired. B, you're going to probably go backwards, not forwards. And C, you might even drown. But if you jump into a river and you swim with that current downstream, guess what? It's a lot easier. I watched something called, you've probably seen it, Born Survivor with Bear Grylls. I don't know if any of you are familiar with that. He always jumps in the river, but he always tries to go with the flow where he can. And that's right, because he doesn't want to use too much energy. And price action is very similar. You'd be amazed how price wants to get drawn to a round number. Now you look at that. If you have a round number, like the British pound, 1.60000, okay, that round number is going to be a very key level. And the market gets drawn to it because it's, human beings, we trade using numbers. Okay, so when we see volume on our chart, it's the activity of the professional money. So it's the gasoline that drives the financial markets. It's the key to the truth. But keep in mind the 2 important things you must always look for, as I'm about to show you. Number 1, remember that volume is activity. As an estimate, about 85 to 90% of the volume seen on the charts will be from the large players like George Soros, the big banks like Goldman, professional trading syndicates and pools. They're nameless. I mean, Tom Williams worked for one in Beverly Hills, California. It didn't have a name, and as he said, it never had a sign on the door. Now, ultra high volume and ultra low volume seen in the right place, in context with the background, are signals from the smart money of their true intentions. And these opportunities often arrive on earnings reports and news-driven events. All right. Let me give you an example of what I mean by that. Okay, Robert asked a good question. He said, when you say the background, how many bars do you mean? I always, when I start my analysis in the morning, Robert, put up 500 bars. And I do that in a weekly, daily, 4-hour time frame, depending on what market I'm deciding. In stocks, I tend to go back 10 years. Let me just quickly show you why that is. Okay? Before I come back to that. Okay. Can everyone see my chart now of British Petroleum, BP? So this is directly, I'm going to answer this question because Robert asked it, and it's a good question. When I look at background, how many bars do I go back? Well, I go back as far as the data will allow me, basically. Okay, this is BP. Now, if I convert this to weekly, now you're going to notice here, this is the BP oil spill, Gulf of Mexico. This was the week they said we cannot cap the well. Now, strength appears on down bars. We call this activity, when we see very big swells in volume, climactic action. Okay, you'll hear me use that term in many seminars. We've got some climactic action. On a down bar means as the price is collapsing on all this bad news, the professional money knows something that we don't know as the public. Now, I happen to have it on very good authority that on this week in June of 2010, we actually had a BP engineer who came to one of our seminars at Heathrow Airport last year it was. And we were showing this chart and Tom said, you know something, when I saw that signal, I rang Gavin and said, let's go and buy BP shares, which we did. And he said, but I couldn't believe the signal because it was on the week they said we can't cap the well and it's going to cost BP billions and billions and billions of dollars. And the BP engineer nodded. He said, well, that was the week we did cap the well. And we weren't told about that for months afterwards. So the week they told the public, the media, we can't cap the well, look at the volume. Now, why is that relevant? Is there a clue in the past as to maybe they've marked it down to a price level that they found attractive? Now, watch what happens here. If I put up, in fact, I can tell you because I haven't got the data on here, but it actually comes down to a 10-year low is where it comes down to. It came down to a 10-year low, and that was what happened to BP. Okay, came down to a 10-year low. Quite extraordinary. Now, let's just have a look at what's going on here. Let me just close that down for a second. Just bear with me a second. I'm going to have to stop projecting for a second, just while I close that down. Right, you should have a chart back in a second. So, before we go and show you the actual chart of gold and the E-mini, and we'll do a comparison, are you all familiar with the term tentative outright treasury purchase schedule? Do you know what that means? The Federal Reserve publish a website. Are you familiar with this? This is information you definitely need to know before we get into the principles. Right. Okay, good. A lot of you said you didn't know what this is. So, I'm now going to show you. So, wherever there's money to be made, you can bet your bottom dollar there are going to be specialists or professionals. And we know that there are professional lawyers, professional doctors, and they specialize. Okay, you have corporate lawyers, criminal lawyers, you have heart surgeons, brain surgeons, even in banking, you have investment banking, you have retail banking. So we know wherever there's money to be made, there is going to be professionals or experts. Now, the smart money, who are they? Okay, someone asked that earlier. Well, you know something? The smart money are just individuals and groups who control very large amounts of money. So let's do a little test then. Who is this top left? Everyone know who this is? Top left. It is indeed. Yep, that is Warren Buffett. Bottom left, very easy, nice easy one to get you going with. It's even got his name there, George Soros. Everybody know who this is in the middle? Just here. There's a bit of a clue right above his head. Yep. Right, let's get a little bit more difficult then. Who's this top right? Gordon Gekko. Well done. All right, then. Let's see if anyone gets this right. Who's that bottom right? Anyone get this right for the prize of the day? Everyone's gone quiet now. That guy that went short in Asia. You're close. Well done, Mark. Yes, he was part of a trading firm. No, he wasn't in a movie. The guy down at the top here, this one, he was in a movie. That's Michael Douglas, who played Gordon Gekko. This is Greg Kofi, who made 600 million Aussie dollars last year. He's an Aussie. And you never would have heard much about him, but if you're in Australia, you probably would. He was the smart money. Okay. So when we're trading in the shadow of the smart money, as we're going to see, we're going to trade in the same direction as the smart money. Now, can the Federal Reserve have an influence on the way the markets move? What do you think? Yes or no? Does the Federal Reserve in America have an influence on the way the markets are moved? What do you think? Absolutely, says Abdul. Absolutely they do. In fact, they know well in advance what they're going to do. And that is why you have these announcements that are made, but professional money are fully aware how much money is going into the system. Now, what's a little bit interesting is that they always pretend in the news that the market's going to do something different. So they come out and said, we're pretty certain that Mr. Bernanke is going to start tapering, which means he's going to reduce the money flow. But of course, the Fed think, we're not going to do that. We'll put that out as a rumour, and then we'll surprise the market, and we'll tell the market we're actually going to continue to pump money in the system. Now, when they put money into the system, it's used by the large banks to buy bonds, stocks, futures, whatever market they're trading. And it's also known, it's called the Tentative Outright Treasury Operation Schedule. And that schedule is available to the public if you know where to look for it. And I'll just put the website up now. Now, this is really important. They tell us a month in advance how much money is going to be put into the system and on what dates. So what is the advantage to me as a trader to know this? Because when I see large amounts of money going into the market and I look at what the settlement date is, you then go and look at the volume on those dates and you'll see that that's the best day to trade. That day and the following day are the best days to be sitting by your computer. There are 10 very good trading days in the month, which if you only traded those 10 days would be your highest probability of making money, because other days the market tests and whipsaws and moves sideways. But notice here how much money is going in. Let's actually have a look at today is the 23rd of September. Let's see if there's any big amounts of money. Yeah, look, the 30th of September, look, the biggest amount this month So expect a big move on the Monday, September the 30th, right, which is a week today. So we've got not a lot of money coming into the market today, look. A little bit came in on Friday. Obviously, we had that sell-off. But this website I'm going to give to you, it's very difficult to find on the Fed site, but as a professional trader, once you know about this, look for those days where money over 2.75 billion is being put into the system. And those are the days that the markets are going to move and give you your best trades. But remember, they mark prices up and down quite deliberately to fool people. A lot of traders, after the FOMC meeting minutes were released, went long, only to find on Friday the market collapsed, went back down to 1,700. That was because the market was artificially marked up, and it was done quite deliberately. So we can see here that on the 26th, we've got 2.75 to 3.5 billion. So on these days, you're interested in the settlement date. That's when the money comes into the market. So what do we actually call this? Pumping money into the market. The Fed are pumping and dumping into the market. And that will affect the volume, and that will give very good VSA principles. And when we're talking about a lot of money, we're talking about 40 to 50 billion dollars. Okay, that's a hell of a lot. So would a trader gain an advantage if he or she knew in advance when and how much money is being pushed into the markets? Of course we would, because we know the days where the heavy volume is going to appear. And those are the days that we then want to see and get opportunities to buy into the market or sell into the market. All right, now let's start getting into some key principles. And we're going to look at some charts now. And you should, and let me just put these two charts together. Okay, on the left, you've got the E-mini S&P, and on the right, you've got gold. These are futures contracts traded on the weekly charts. All right, now we're going to start by talking about climactic action. I'm going to show you what we call a buying climax and a shakeout, and I'm going to show you how you trade them. Okay, so we all saw that Goldman Sachs raised their gold price forecast, and let me just remind you of that. Okay, now look at the date and make a note of that date. Okay, so it says Goldman Sachs raised its gold price forecasts, citing the fall in US real rates and intensifying sovereign debt issues in both the United States and Europe. Okay, so we've got here quite clearly signals from the fundamental analysts at the bank that gold is going up. All right, now on the right is gold. That is the same week that we had the news from Goldman Sachs, and you can see the volume is absolutely massive on that price bar. And I've drawn quite deliberately 3 red lines on that bar. Okay. Now there are 2 things I want you to write down, 2 rules. So if you've got a pen and paper, you might want to write these down. Rule number 1. When strength appears in the market, i.e. buying opportunities, it happens as the market falls on a down bar. And that's a price bar that's closed lower than the bar behind it. So strength appears on down bars. That's the first rule. The second rule is as follows. When weakness appears on up bars. Those are price bars where the market's clearly gone up on very, very high volume. Now, we'll start off then with the E-mini S&P futures contract on the weekly chart first of all. I've drawn 2 trend lines on here that I'm going to spend a little bit of time explaining to you, because where we're at right now is the reason I think we're going to actually have falling prices in the S&P tomorrow. Now, first of all, Does anyone notice on this chart of the E-mini S&P any unusually high volume? And if so, where do you see it? Do you notice any unusually high volume? And if so, where do you see it? Okay, so everyone is quite correctly pointing here. Okay. Now we'll notice first of all then, just there, let's look at the date of this bar. 12th of August, okay, 2011. Now the market's plummeted. The bar behind it has rapidly fallen, and that was because S&P 500 were going to downgrade the US government, which they did this week. Now the news here was that, of course we know, was that gold was the safe haven. But this and that bar there and that bar there are a classic Wyckoff setup. Classic. This is what we call a springboard or a spring. How many of you have heard of that saying, a Wyckoff spring? How many of you have heard of that? A Wyckoff spring. Okay, well, let me explain what's going on here. First and foremost, the news is bad. So when you see this type of setup coming, the news will probably be putting you off from even thinking of buying. Now, as the market fell here, what do you notice about where the price closes on the bar? What do you notice about where the price closes? Just type it in. What do you notice about the closing price on that price bar? It's not on the bottom. No, it's not in the middle. It's up on the top of the bar. All right. Now, only one thing can cause the price to close up there like that. Some sort of demand has to have overcome supply, but there's still going to be an awful lot of sellers in this price bar because they'll be panicking. And there was panicking. Gold was going up. The S&P downgraded the US government, and they said for stocks, we could see the S&P going through 1,000, possibly hitting 600. So the news here is very, very, very bad. However, this is the start of a VSA sequence of events. And these sequences have been programmed in to the Infinity AT charting software and Sierra charts. And it sends me an email when certain criteria are met. Yes, Andrew, this is not bag holding. No. And I'll tell you why, Bill. Good comment. The reason it's not bag holding is the range of this bar, the spread of this bar, is extremely wide, and there's price action to the left. But now you've asked the question, if this was bag holding, this was what it would look like. There would be a big downtrend in place. All right. There would be no price action to the left here. And then as the market falls, you'd get this surge in volume. It would stand out. But instead of having a wide spread, you'd have a very narrow spread bar closing in the middle with the next bar closing higher. Now that is bag holding, and the market would probably just bounce off it. Most often it does. So that's the big difference, is here we've got what we call a shakeout in the market, because the difference between a shakeout and bag holding is the spread of the bar. Now, what does a wide spread tell us? It tells us there's a lot of panicking traders who are desperately trying to get out of their positions. And so here, professional money here are quite happy to rush in and buy, but they're not. There's a battle going on between sellers and buyers. And so when we see a shakeout like this on very high volume, that's not the place to buy the market. If that was bag holding, I would have said, yes, you can probably go long straight away. But there's a reason we wouldn't go long on that bar. Can anyone tell me what they think it is? What's the reason we would not at that point go long on that bar? Bill says no confirmation. Well, that's exactly right. Yes, the next bar actually closed lower. Well done. That's exactly right. There's still too much supply around. There you go. You've exactly got it. There's still too much supply in the market. What does that mean? There's a lot of sellers still there at that price. And so what happens is the market goes up, it's upthrusted and comes straight back down. But now this bar here is quite telling, okay, because you've got a shakeout here and the market dips below the low of that bar, but it closes on the high. Now that is a test on very high volume still, but it is a test. And again, the software tells you here, they're testing something. What are they testing? They're testing a shakeout. I mean, look, signal's spot on. A test, and you've got a shakeout in the background. So you've got a serious sign of strength. But there's one other reason that we wouldn't want to go long, even on this bar. Can anyone tell me what it is? Downtrend, exactly. You're still trending down. You've actually got a sign of weakness in the background. And at this bar here, forget these other bars, has the market changed behaviour, as David Weiss says? Has it began to move higher and make higher lows on each bar? No. In fact, it made another low here. But look at where it made a low into this previous reaction point. Now, these two bars here are called a spring. A spring. Because they're both closing up near the high of the bar. The volume on this test is lower than the massive volume on this bar at the same price level. So we now know that the demand down here must be greater than the supply, but we still don't want to go long at that moment in time because we still haven't changed behaviour. But what we're looking for now is a signal called no supply now, meaning the market is marked down quite deliberately to flush out any sellers. And if there's no more sellers around, the volume will now be much lower, very much lower. So watch what happens here as we respond to the spring. Watch what happens as we have 3 weeks, 4 weeks of falling prices back into that area. What do we all notice about the volume as the price retraces into this bar here? What do you notice about the volume? Ultra low. It's extremely low. Massively low. The volume is, every time the price falls, the volume is decreasing quite substantially. And in fact, on this week here, we have a down bar with the lowest volume for about 12 weeks, as we can see. And if we put the signal on, no supply. So why is that signal in the right place? Because you can see this signal in uptrends, in downtrends, with weakness in the background. But why is that, do you think, in the right place? Well done, Edwin. That's exactly right. So why is it in the right place? What do you have immediately behind you? When I refer to the background, what do we have in the background? We have a shakeout about 12 weeks prior on massive volume. We then have a spring, a successful test. And now we have no supply. And from there, which marks the bottom, look at where this price action's going. We're in a massive bull run because of what happened over the period of time from here, from August 2011 through till November 2011. And this is what Wyckoff called the primary phase of accumulation. It's the main phase of accumulation. But the trend, the long-term trend, is still very, very bullish. Because if we look at the bottom of the market, where the initial distribution, accumulation took place, it happened in October 2008 at the beginning of the financial crisis. So whilst this is what confuses people. I did a speech a few weeks ago, and I looked up and I'm looking at the audience. And I said, this is the greatest bull run we've seen this century. And they all nodded and went, no, this is not bullish, Gavin. Have you seen the news? We're in a depression. We're in a credit crunch. And I said, I'm sorry, but the chart doesn't lie. We've made new highs. The S&P's heading up towards 1700. In fact, I predicted it would go to 1754. Last week it went up to 1720. But it's all because of what happened here and what happened here. Now, let me ask you a question. Does any of you see at the right edge of the chart volume equivalent to that size and that size on the weekly chart? Yes or no? Do you see any volume of that type of magnitude up on the right edge of the chart here? Yes or no? Do you see anything of that magnitude? And let me just be clear what I'm talking about. That's the top of that volume bar right there. Do we see anything of that magnitude over to the right? There's nothing even close. There's nothing close to this or to this over here. That is buying. That's the second phase of buying. There was some very high volume down here as well. Yes, that was the flash crash, where they marked the price down, stopped everyone out, and then bought more. But this market is moving in phases. And if we look at the waves on this, we can see here, after this initial accumulation phase here, we have a really strong up move, fairly shallow down move, another move up, another move down, then a really prolonged move up, another move down, and now we're going back up, and this wave has yet to complete. So the reason I think we'll see lower prices possibly this week is professional money are going to want to buy more. Now, we have to look at the right edge of the chart and say, does that look like an upthrust? And the answer is yes, it does. But I think they're going to want to buy more down there at 1670, 1680. But all the way up in an uptrend, we're looking for signs of strength to appear. But most importantly, and the principles I want you to look for, is no supply after you've seen strength come in. That is a very strong trade setup. And guess what? That very same setup will work on a 1 minute chart as well as a monthly chart. Now, that sounds impossible, but I can assure you, I traded that setup on Tuesday of last week. And it's very simple to see. You have a wide spread down bar like this. Then they mark the price just below the low of the bar, but it closes up near the high. And then you look for that first no supply bar. And you get long when the diamonds change to green. Now, this took, because it's a weekly chart, 4 months before it really started to move. But on a 1 minute chart, it takes 30 minutes or 20 minutes. And often, with that type of volume in a shakeout, you'll get a 4 or 5 point move in the S&P, which trading 10 lots can be very profitable. So Robert's asking, is a sign of strength test after shakeout equivalent to a spring, or is that oversimplifying it? No, Robert, it's exactly what you're seeing. It is a form of spring. You have a shakeout, and then you're having what's happening on the test bar here is that the market is responding to this strength, and it's actually building what we call a cause. Okay, a cause to go up, because the markets move. Let me just show you the universal laws that drive the market. Just bear with me. The universal laws that we see in these charts, I believe there's 4 laws that you need to be aware of. 3 of them you see on the chart. The 4th one is what I'm writing my next book about, which is called the law of attraction. It's actually how you attract money. I mean, there is a human way, believe it or not, that you attract money to yourself by being positive, by being always very, very grateful for what you've got. But the law of supply and demand is talked about a lot. We hear about that in oil, don't we? I remember they were showing the oil market in 2008. And they said, in 2008, we're running out of oil, and oil is going to go to $200 a barrel. You might remember that. And I'm going to show you what no demand looks like at market top. We're going to do that in part 2. We're going to show what weakness looks like. But when we see no supply and no demand, you never really hear about that on television. So they talk about supply and demand. In fact, in the oil market, there is a cartel that controls supply and demand. Does anyone know who that is? And Edwin's asking, what's the difference between a no supply and a test? I'll talk about that in a minute, Edwin. It's a good question. What's the difference between no supply and a test? Yeah, it's OPEC. OPEC. All right. OPEC controls the price of oil. Ironically, during the height of the BP oil spill crisis, we were told on the media that if they didn't cap the well, it would gush indefinitely. Means it would never stop. But 2 years earlier, they were telling us that we're going to run out of oil very shortly, which is why the price is going up. They must think we're all pretty stupid. But that's the way these things work. So you have the law of supply and demand. Then you have cause and effect. In price, the cause is built by the volume. And then the effect is where the price moves. And then we see effort versus result. The effort is found in the price. Where does the price close is the result, and the effort's in the volume. And it's all there. It's the energy of the market. It's the energy of the market. So as Robert's asking me, a spring must occur at an area of support. By its definition of a spring, it's supporting the market at that level. It's making its own support. So if you look at that area there, this is finding a key support level. But if you go back in the past, you'll often find there might have been some reason that it's springing off that level. And here's the reason why. Look at the top of the bar. All right, I've put a green line across it, Robert. Notice how the market here is marked down. We have climactic action. Remember I told you the background of the chart is extremely important. Now the price action goes through here, comes back down here. But look what happens nearly a year or two later. They bring it back down to the top of that bar. Almost look, if you look at the top there, 1103, we get down to 1077, almost to the tick there before they buy it back. So that was a key level for the smart money, and that's where they sprung it. So by definition, this area here, which was the collapse of price when Lehman Brothers went out of business, now acts as support. So it's springing off a very clear area of support in the background. Abdul says, so a spring can also potentially trigger short covering, which absorbs any remaining supply. Yeah, absolutely. So when you see a spring happen like that, always look how many bars I've got up here, 500 bars. Look at the big picture of the S&P now. All right, here's your declining price prior to the crisis. Okay, in the banking sector. Now it was here at these lower levels that professional money saw a good reason to start buying stocks, because they could see that, yes, we're going to go into a tough time, but these stocks were good value. So all the stocks making up the S&P 500, some of them were very, very good value. So here, the market comes back down and springs off the top of this line. And then if you have a look, we'll see that as the market falls in this trend, it's falling to the lower trend lines and being absorbed more. So we're getting more buying at these middle trend lines. Now, the trend lines I've drawn on here are basically quite easy, and I'll do them again for you so you can see how we draw trend lines. Let's delete them, and I'll show you how you draw the trend lines. These are what Wyckoff calls, well, Tom Williams used to draw trend lines and felt they were a very important part of trading, and they are. First thing you want to do is find where you think the bottom of the market is, which is actually down there. You can see it clearly. Now, the second thing is we want to take the first two lows in an uptrend, and the Trade Guider software automatically selects the intersecting high. However, we can actually use our eyes and do it even better than the computer if we see an area in the background where we've got a level. And let me show you how we do that. So we're on the low here. we put on the trending system here, the trending tool. We take the first low and the second low, which is right there, and then let go. And it should pick out this old high here. Now, I can see that in the background there and there, we've got a high in the middle, which if I projected that line out, would give me a very good upper trend line. Okay, or we can call this the supply and the support line. So let's move it back, which I can do manually, to the top of that first bar and see what that looks like. Again, it's all using your eyes here. We're not trying to be clever. There's the top of that bar there. Now look at that. Now there's a lovely channel, okay, because I can see, look, when I've projected the line out, look how we've hit it once, hit it twice, and look, we've hit it a third time and came back in. See how that line there now got hit over here and rejected it. So I know that that's a good trend line. So I then put in my center line and my quarter lines, or my quadrants, and we project that out. So that's my first trend channel. And you can see that, first of all, it's got strength in the background here, it's got more strength here, and there's no serious weakness. So what's the chances the S&P are going to go higher? Let me ask you all. Are you bullish or bearish for the next 12 months on the E-mini or the S&P 500? What do you think? You bullish or bearish? Bullish or bearish S&P, everyone? Very interesting to see what everyone says here. Okay. Interesting. Very, very interesting. Well, I can tell you, right, and there's nearly 80 of you here, I think, that it's about 50-50, which is quite interesting. Now, let's look at it as the market unfolds. Long term, I'm not going to be bearish on the S&P until I see equivalent volume on the upside. Now, let me tell you how that's going to happen. What's going to happen over the next 6 to 12 months will be this. The news will start to really recognize this big bull run. You've already had headlines, S&P makes historic highs, but the public are still sitting on the sidelines. Many stopped trading. They missed this massive move because of the fear and the uncertainty that's set in about Europe and everything like that. But all of that is media coverage designed to create uncertainty. So what happens here is that the public miss this massive bull run. Or worse, they went and bought gold and have watched their investment decline from 1900 to 1200. So everything they were told in 2011 about the markets was wrong. Gold was not a safe haven, and the S&P became bullish because of the no supply in a weekly chart, which we saw here, with strength in the background. And lo and behold, and Alexander is saying there's some clear supply in 2007 back over here. Yeah, you can see what happens as they mark the price up here. I mean, really, what happened here? I don't think this was obvious. But what I did think was more obvious was as this trend came down and we saw the swell in volume on the down bars and we began to go up, this news at this time was so fearful that it made me realize the markets move like that. If you see bad news about any instrument and you see the professional money coming in and showing you the volume and saying, hey, we're buying, you've got to pay attention to that. You've got to pay attention to that. Andrew says, it often appears that you have strength and weakness at any one time. Of course you do. Let me answer that and explain why. The market is fractal. It doesn't trade in one time frame. When it's open, the forces or the imbalances of supply and demand are constantly flowing, which is why in part 2 I'm going to show you how we use more than one time frame to take our entries. Look, I might be bullish long-term S&P, but I made, Steve Phillips and I both shorted the market on Friday and made a fortune. So, you know, I don't know if Steve took the trade. I know I took the trade. And it's the same with the Aussie dollar. Long-term, it's been in a strong trend, but at some point, you're going to clearly see but there's an opportunity to go short. So this comes down to multiple time frame analysis. Some traders I know have been long S&P for 18 months. They don't care that it goes down 30 points or 50 points here or up another 100 points. They're taking a long-term view. I've got other traders in our trading community who trade a 1 minute, 2 minute and 3 minute chart and are in and out the market within 15 minutes. They can still make $2,000 or $3,000 a day doing that, but that's their trading style. Now, with my trading style, I love to trade the currencies and I love to trade gold. And what I tend to look for is where there's clear imbalances of supply and demand, and then the trend begins to change over in multiple time frames. So we've got another half an hour before we take a break. Let's go and show you that whole principle. Now we're going to start to look at weakness. But is there any questions on shakeout and no supply? Because what I want to talk about is the difference between a shakeout and bag holding before we move on. But is there any questions at all about this area here that we just talked about, which is a great example there of strength coming in, followed by no supply and a rally? Hey Pedro, no problem. We've recorded it, so don't worry. We are recording this. Right, Edwin's asking, what's the difference between no supply and a test? All right, now, here's a test. All right, the volume is less than the previous two bars. The next bar closes higher, but we still have falling prices over the following weeks. No supply is the best signal, the best time to trade it is after you've seen very high volume on a down bar and you see no supply. But you'll see that when Tom describes no supply, he often describes it as a test as well, because it is a form of test. Now, Wyckoff in his day had 9 buying tests, 9 different types. For me, no supply as a signal to go long is really only very relevant when you've got that shakeout in the background. If I see no supply and there's no real strength in the background, it doesn't mean as much. But here it means a great deal. But a test is a markdown on the bar to find if there's any willing sellers around at a certain price level. If there's no supply left, there's no more selling pressure, the market will respond positively. It's always about 2 bars. But is there a big difference between no supply and a test? No, they're doing the same thing. The terminology is different. And in fact, I was asked a question the other day, Gavin, in your book, you've got like 15 different signal numbers for the same signal, no demand, or you've got 10 different numbers for tests. Why? Why just not have one number for the same thing? I said, because the code, the computer code for each of these signals is different. They're not identical. The code is different. So it has to have a different number. The principle is the same. The principle is the same, but the coding in the signal to bring up a signal has different restrictions and different rules with it. But, you know, Edwin, I wouldn't get too wrapped up in what's the difference between no supply and a test, because what they're both signals are trying to do is to flush out sellers at certain prices. And if there's very low volume, but most importantly, and you read the dialog boxes, okay, we need the next bar to close up after you see a test. That's a very good signal in its own right. If you've got strength here and the market comes down on a no supply test, but the next bar responds positively, that's a very strong signal, because you've got strength in the background, a shakeout. You've now got a test that's successful, and then you change behavior. Look, we start to make clear weekly progress. Bill's asking, is the code different because of the background? Yes. Some of the signals look at the background. That's right, Bill. Absolutely. Sometimes the text is identical for the different numbers. Yes, it is. Because although there's restriction, I'm going to say more than I usually say about our rule sets now, but as you'll hear on the mini mentorship course, when Tom wrote the signals, you'll find there might be 10 signals with the same description to it, and yet they've got different numbers. It's because the reason they've got different numbers is there are different restrictions on that rule appearing. However, the principle would be the same. So you might have a reversal, sign of strength 57 and 58 with the same dialog box, but the principle is the same, and yet the coding is very slightly different. And that's the reason you have these different numbers which appear to be for the same indicator. And it's quite clever the way Tom has done it. He described to me when he was programming this, he said, Gavin, when I programmed in VSA, you'll notice you don't have signals on every bar. He said, and when I first started, the reason we had too many signals was because I didn't have any restrictions in place saying to the computer, look at X, Y, Z before putting a signal on bar A, or look at X, Y, Z before putting a signal on bar B. So there's restrictions in the VSA rules to ensure they don't appear all over the place. Now, Mike's asking, do you get the similar ultra-high volume at the top of trends? I'll show you in a minute. Please be patient there. I'm going to come to that in a minute and show you that. I'm going to actually show you that. Okay, so let me go to a screen now, and I'm going to go to a blank screen. And I just want to show you the difference between bag holding I'll use Microsoft Word. There we go. Right. Okay. So this is the easiest way to show you. Yeah, I'm going to take a 15-minute break in about 10 minutes, Robert. Yeah, about 10 minutes time. So when we're talking about no supply, which we just talked about, it's basically a test. That's what no supply is. It's testing the level to the left. Now, the question came in, what's the difference? How do we know the difference between bag holding, which is a very strong signal, and say a shakeout? Well, first of all, when a shakeout happens, this is what tends to happen. You tend to get a widespread down bar, then the market goes back up here, and then we have this widespread bar. So it starts its life by the price ticking down. Usually there's a lot of panic associated with it, but then it comes back up and closes up near the top, like so. Now the volume here will probably be ultra high. And unlike bag holding, there may well be some price activity at the same price level to the left. So the volume here will still be very high. That's important on that bar. But bag holding is different. Now, let's put up all right, let's put that in there. Right. Now, bag holding. Here's what happens with bag holding. This is what really makes this signal powerful. First of all, there will be a downtrend in the background, like so. All right, so the price is always falling with no support. Now, what will happen here is this will be the volume, as you can see. All right, so you've got pretty much the volumes coming down. Now, remember, in a downtrend, you have increasing volume on down bars and decreasing volume on up bars. Now, with bag holding, the first thing that you must have is a downtrend behind you. That's important. For that signal to really work, there has to be a downtrend behind you. Mike's saying this is almost always price activity to the left. 500 bars and 200 bars are what I use. But there's no actual defined number. In the market, it's very difficult to define an exact number to look for. It's very much with trading and investing, you're using your eyesight and saying, is that a downtrend? Is there any price action very close to me? I start with 200 bars and then I move out to 500 bars. If you see there's no price action for 500 bars and you're in a strong downtrend and you see bag holding, the chances are you found the bottom of the market. So what does it look like? Okay, and of course it depends on time frame. The bigger the time frame, though, I will say this, the bigger the time frame, the bigger the move. So if you see bag holding on a weekly chart, it's going to have a much bigger impact on the market than if you see bag holding on a 1 minute chart. All right, so yes, the bigger time frame absolutely makes all the difference. If you see bag holding on a weekly chart, you better ring your broker. And as Tom once said in a seminar, but I don't advise you to do this, he said, if you see that signal, mortgage the house, sell the car and put it all into the market. That's not my advice. 2.5% of your capital in any one trade. Nevertheless, when you see bag holding, it's a very, very strong signal. Now, this is what's going to happen. The market's going to have been declining. You're going to have no price action to this level to the left. Suddenly, the price will often gap down. Very often this happens. And the volume will be like that. And the spread of the bar will be extremely narrow, closing in the middle. Often it closes in the middle or high. But what makes it is that it's a narrow spread on this bar. And the volume is obviously much higher than the other bars behind it. Now, once that signal has appeared, look at the next bar. Because this will very often just mark the bottom of the market. And what the market often then does, the next bar should close higher than the close of the bag holding bar, just to confirm that demand has overcome supply here. That's what's going on. Demand, this is difficult to write with this pen, but you can see here what I'm getting at. Demand is overcoming supply. Something is capping the bottom of the market. And only one thing is causing that. For every sell order that's coming in from the panicking public, it's immediately being bought by smart money. Now, on this day, assuming you're looking at a daily bar, you will not want to buy, I can assure you. You definitely won't want to buy. And here's the reason why. You'll switch on the television and look at the instrument concerned, and all the news will be bad. It will be terrible. And you'll be second-guessing yourself. But what you want to watch out for, when I see bag holding, although Tom goes straight in and buy, I wait for something else to happen. I wait for the market to test the top of the bar. So the market comes back down after moving up a bit, comes back down to the top of that bar, and you have a low volume test. And it can be no supply or it can be a test. Either one's good. And that's where I go long. And I can tell you on those type of days, when you see that indicator, it's a very powerful indicator. Now, it's a good question. Do you see these in trends without having to have this big down move behind you? Yes. And they still work. They work just as well. So what we've done, we have programmed this in to the Infinity platform to find for us these indicators, and I'm going to go and see if there's any up there now. Let me go and have a quick look. And what I'll do is I'll show you now the scan and whether we've actually got anything happening. All right, interesting. Now, first of all, let me just put up my Yahoo account so you can see what's going on here. Right, and I should have already set this. Okay, so I've got a couple of... Can everyone see my screen? Can everyone see my screen? Okay, so I've got two alerts that have just come in. All right, now, so what's going on here then is I have actually set in my Infinity charting package an alert to tell me when certain sequences have appeared. Now, in gold on the 5-minute chart, we've just seen an upthrust followed by number 146. So we're going to see what that says. And there's another one just here that came in 20 minutes ago. Okay. Indicator 71 is found on the 5-minute NASDAQ chart. All right, so let's go and have a look at the NASDAQ and we'll see what that indicator actually is. All right, okay. So we'll go to the NASDAQ, okay. We'll go and see if there's a key principle. So we'll look at the 5-minute chart of the NASI. And we can see there is some principles here. Now look at the volume on that bar. There it is. Okay. Now this is the signal I'm just about to, now I should have shorted that. I'm a bit late, but I'm not trading live. So there is a principle that I'm about to teach you in part 2, and you can see what the market's doing on that principle. All right. So I've had a trade alert via email that there's an end of a rising market, which, as you're going to learn in part 2, is one of the highest probability principles that we see. And the volume is very, very high, as we can see. And you can see as a result of that what the NASDAQ's actually doing. Now, the question now is, can I get into a trade here? Let's have a quick look. You can see how very quickly the market here, it's gone into fresh high ground. It's a narrow spread. The next bar closed lower. Then they upthrusted the market here, but now the market's changing behavior. So let me see if I can, just going to get my trading dome up and we'll see if I can get, I'm looking now for confirmation of this signal. Right now, can anyone have a guess what I would be looking for here for confirmation to take a short trade? Because it's pushing up at the moment, but what would I be looking for confirmation? See if anyone can have a guess. It's not no supply, because that would be strength. And we've got weakness here, as we're going to learn about in part 2. Yeah, well done. Very good. Yeah, obviously got a lot of VSA traders here, but you're absolutely right. Now, after seeing that principle, you expect the market to fall, which is what it's doing. So what I'm going to do is I'm going to look for no demand on the smaller time frame. And if I see that, I will take a trade here. I will trade that, definitely. I'll try and get short. But I think you're going to see the no demand bar. And in fact, I'm going to stay with you just for 5 minutes, and then we'll take a break for say, 10 minutes. Because I am actually going to show you it's worked out perfectly, this has. This always happens to me. I'm very lucky. I'm doing a seminar and I've got PowerPoint slides to show you, and then a principle appears live. It's a wonderful thing when that happens. Okay, so now we're waiting for the market to prove to us that it's weak. It certainly appears weak. This has been marked up. This has been marked up. As we can see, we've upthrusted here. And now we're just waiting for confirmation. Okay, so this could indeed just take off. It could just take off to the downside. I mean, look, I'm kicking myself a little bit because I've just been covering the signs of strength, but I love showing the signs of weakness when they're appearing. And we had an email, number 71, which is the end of a rising market. And I'm about to show you that. But this is what it does to the market. This is why it's a very good short opportunity. And you could use a 3-minute chart, absolutely. Yeah, Charles, nice to see you. Yes, there is. Charles says, is there a different equivalent to bag holding on the upside? You're watching it live. That's a live end of a rising market setup. I'm not going to chase the fall in price, but I should have been short, certainly on that bar, because it's confirming the end of a rising market. This is why the price is falling. Look, Charles, you can't ask for anything better than that. I mean, it's into fresh high ground, narrow spread look, you can see. Then they upthrust it, and then you have another upthrust over here, look. That's a trap up move. That's what I call the gotcha bar. Now we will get now a change in behaviour. So you will get the red diamonds. And all we're looking out for now is no demand. And I'll see if I can get an order in here and get short, because that's a great principle. Are you lucky or what, Charles? You're very lucky. Look, sometimes, when you're sitting here doing these seminars on a Monday, you don't know if it's a good day to trade or whether they're going to come and test the lows. That principle, which we've built into our alert system, is the principle I'm going to teach you about in part 2, and it is a very, very high probability short setup. Well, I would, if I can get short here, I would look for profit targets at the previous low of the day, which is down here, because that's where it'll go to, because it'll come and retest. What they'll do now is test the low of that bar. So that would be where my profit target would be initially, at 32.13. This thing could just keep going short. Yeah, it could do. It could do. It's very weak. Is this my favorite signal? Yes. Yep. That's why. And in fact, the gentleman that programmed this into the Infinity platform is called Grigory. He's based out of Russia. He's in here with us today. And he will, I'm sure, agree with me that is a very high probability setup to go short. And he's actually back tested these indicators and knows what their probabilities are. This one is very high. Look, I'm not even going to catch this trade. It's just taken off. Okay, let's go and have a look at the 2-minute chart then. I'm just going to put the NASDAQ up on my other computer here. Yeah. Oh, it's lovely to be able to show you this live. Absolutely. Yeah. Oh, you can see it on the 3-minute chart. Yeah. Yeah. Let me. That's a cracker. Yeah, you can see it. I mean, they all look different in different time frames. Oh, this is a setup. Yeah, let me. Sorry, I'm gonna overrun a little bit here. I'm trying to see if I can get short here with a target of 3213, but I don't want to start shorting and chasing the market. You don't want to chase the market. Let the market bounce back up. It will do, and it will give us a setup. Let me show you this in Trade Guider just to show you now how I actually trade this. So as we were going to be talking about this principle, lo and behold, we've got one in a live market, and you can see how powerful this is. So here we go. We've got the setup's very clear. We're marked up. Oh, here's the top for this evening. Okay, for yesterday evening, you can see we marked up, totally artificially marked up here. So they mark it up again, and now look what happens to the thrust on each bar, which is the spread of each bar. Notice we have a wide spread. Notice we have a narrower spread, and notice we have a very narrow spread on much higher volume than the previous few bars here. The next bar closes lower, which confirms the end of a rising market. Then they trap everybody, and we have this big down move. It's about a 10-point move already in 15 minutes. Now, I think we will get a no demand bar. Okay, that's what I would then look for confirmation to go short. So there's no strength in this market at the moment. It's being sold off, as we can see. And Andrew says that Richard Ney says that the market will always change direction after the first 50 minutes. Very often they do that. You've got another 10 minutes now. The market's been marked up. It's definitely been marked up. Okay, that's not a strong market at the moment. It's been marked up, and we can see, look, this is the end of a rising market. It's got very high volume on it. In fact, Trade Guider is detecting that as ultra high, which it is. The next bar closes lower, and if we read the dialog box on this signal, you can see why we had an email alert on it, because it's now been programmed in to find this signal. And, I'm always staggered as to how accurate these signals actually are. See if I can get it to come up. Okay, well, I'll explain that in part 2. Let's see if we can get a no demand here. Oh, right. Okay, Charles, have a safe flight. All the best. Good. Glad you're enjoying it. Mark says, this is a very difficult time for me. I know what you're saying here, Mark. I will get impatient and start chasing the market, and there's no demand bar, and we'll miss a big run. That on this signal, that can happen. Look, I haven't seen a no demand bar, and it's moving. But, you know, I am always patient. Look, it'll give us another opportunity. That is a very powerful signal. There's no doubt about it, though. That's better. So I'm just looking at all the questions coming in. So yeah, I mean, when you see the end of a rising market like that, and it comes in with the next bar down, it's going to have this dramatic drop. But don't, you know, yes, we've had 4 down bars here. It could go all the way back down to where the target is. But usually the market maker will want to hold it up just for a little bit. And if it goes up here on no demand, and sometimes it can actually go back up here on no demand. But very rarely do I see that. I just think, you know, on a 5-minute or even a 3-minute chart, it looks quite obvious as well. On this 3-minute chart, you can see up at the top here, look, you've got very clear principles. For some reason, the dialog boxes aren't coming up at the moment. I don't know why. I'll restart that in a minute. But yeah, you might see a no demand bar here on the 3-minute chart. So if you want to get into the trade, go to a smaller time frame. But what I am noticing on these downward moves, the thrust is getting slightly lighter. So I would expect it to try to pop up. But that's as good an example live as we're going to get. Is you see a no demand, you see a end of a rising market principle coming in. Let me go and leave the scanner up. And what I'll do while we're in the break here, I will put the chart up on the other screen. The first red signal after the end of a rising market was a trap up move, number 58, which is exactly what it does, Mike. It traps you. And what about the role of the trend? It's just trending down now, in fact, William. If we look at the chart here, you can just see that on the, if I put the, let me just put that up here. Let's see if I can put the 3. That's a 5-minute chart. You'll see it, the diamonds are just turning white. And what we're looking for is a pop back up and a no demand bar at sort of that level at 3226. At the moment, though, it's that signal is so powerful that the market's still coming off at the moment. You know, and as I said, that happens in trading. Sometimes you're going to miss those trades. Other times it's going to give you the no demand entry. But in this occasion, you're seeing the power of the end of a rising market. And the bag holding signal, by the way, at the bottom does exactly the same thing. The market will just bounce off it. Yeah, it's very, very weak. Great, good. Yeah, glad you're enjoying it. Well, I like to show these things running live, and sometimes we do when we're teaching, we miss an opportunity, and I will have to say that was a missed opportunity not to get short a lot sooner. But look, I wasn't here to do live trading today. I was here to show you the principles and teach you the principles, and I think it's going to 3213. Absolutely, I do. But you know, it just how quickly it gets down there. It's if it goes through the low of that bar, of this bar here, if it goes down through here, which is where I think they're going to mark it down to, then again, you will see, I'm almost sure, a no demand bar. Okay, don't worry, we will see one. But it is quite frustrating, I can imagine, for those of you that see the end of a rising market. I've been telling you how powerful it is, and you're watching it live. But I think you'll see a no demand bar. You very often get the confirmation coming in. All right, I'll tell you what, it's 15:06. Let's take a 15-minute break. So let's come back about 20 past the hour. How about that? And I'll leave the charts running, and I'll leave the recording running. And if I see if I can take a trade, I'll let you know if I can get into a position here. But I hope you're enjoying this. As I say, in part 2, we're going to talk a lot about the end of a rising market. And then we're going to talk about no demand. Those are the two other key principles. And we're also going to talk about where maybe we wouldn't trade, where there's no trade setup. I have to admit, on this particular showing on the NASDAQ, that's about as good as it gets. You see the signal coming in on an alert, and the market just took off to the downside. That's how powerful these signals are. If you just traded end of a rising market and bag holding signals, you would be a very poor trader not to be able to make money. But again, if you didn't want to get in on the signal and take a short, because they will they'll use an upthrust like they did here. Look, to try. If you'd shorted here, you'd be under pressure on that bar. But this is what they do before they mark it down. Gregory reckons the 6B may have a trade on it as well. So while we're watching that chart, I'll go over and have a look at the British pound as well. Keep an eye on the NASDAQ, but let's have a quick look at the pound. Yeah, it looks like they've got a bit of stopping volume on there on the pound. Yeah, there's quite a lot of supply present there. What are you looking at, Gregory? Are you looking at short on the pound? Yeah, okay. So Gregory's saying there's a potential short because we've got a gotcha bar on the British pound, and I can see where you're saying that. Yeah, it looks like the pound, it's in a very serious resistance level up there. Yeah, I'll certainly have a look at it. All right, everyone. I'll see you back here in about 10 or 15 minutes. I hope you're enjoying it, and see you back here shortly. All right, hi everybody, welcome back. As you probably saw there, I actually took that trade on the pound that Grigory had alerted me to there, and I actually took my profit right here. So I caught a piece of this move down. Let's explain to you what I did. Yep, good Grigory. So Grigory took it as well. Basically, we traded there. It was just before the break. I put my order in after seeing the upthrust. You've got weakness in the background here. And so literally I chased the market down because it does that. It gives you a move and it pops straight back up again. So it may even give us another trade potentially to come down and retest that level. But I wouldn't want to be short yet at the moment. Yeah. How's the volume, by the way? Can everyone hear me all right? Pedro said it was a bit quiet. So can everyone hear me? Good. All right. Everyone says the volume's good. All righty. Okay. Well, what a day to be doing this. So yeah, when you've got a fast moving market like we've just seen, I traded 2 lots short. Just so you know, as you can see, I was short from 6026, and I got a fill there at 6011. So I took a decent piece of the move out, and then it's gone straight back up. Look to almost where my entry is. After we see the strength coming in, look, you've got buying on this bar, narrowing of the spread. You've got 2 signals. This is a 1 minute chart. Just goes to show you the principles are on the 1 minute chart. But what I really liked was about this setup was if we look here, let's get rid of the gold chart. In fact, let me come back to that. I'm going to get rid of gold for a second. Let me just show you how I traded that there. We were just coming into the break, and you can see we got weakness on this bar. There's supply coming in. But the market had been trading in a pretty tight range across here. So put up a couple of 100 bars, you can see where the distribution took place and where it started. There was a buying climax, which is one of my favourite signals there, which moved the price down a little bit. And then up here, we had supply coming in. Here, more supply coming in, and there's a round number below me, right? It's a round number. 1.60000. Now, I mentioned earlier on in the seminar that number in the pound was going to be important, and look where they took it down to, 60007 before it was bought back, and it's popped straight back up again. So the principle there is a beautiful one. You've got signs of weakness here, which we can clearly see. All right, you've got trap up moves. You've got a clear example of a weak bar here that's taken out all the prior support. And that's where I actually went short, and then I chased the market down. Some of you may have seen that, and I got my fill as the market popped up just here. And so that's what we look for from a VSA perspective is there a round number below us? Is there weakness in the background? Yes, there is which is a 1 minute chart. So all the principles that I just showed you on the big time frames will work on the small time frames. And that's live. Doesn't get any better than that when you actually see an actual trade that I would consider to be high probability on the short side there. All right, because you've got weakness in the background, the market's mushroomed over, and then this bar here is serious weakness. It's taken out all the support. I've got the change in behavior. The diamonds are beginning to turn red. I put my stop above the last reaction high, and as soon as the market moves in my favor, I just bring my stop to break even and into profit, and then I took a piece of the move. Right, let's now talk then about no demand and the end of a rising market. And we'll go and have a quick look at that NASDAQ again as well and just see what that did, because that was a very good example of the end of a rising market. Did it come down to, so it came right down through, look, that to that low of that bar. So it did come down. Now, did it give us any no demand bars on the smaller time frame? Let's have a quick look. Really, that was one of those examples where it just didn't stop, did it? It just didn't give us any respite. It just took off. But it goes to show you the power of the end of a rising market when you see it. It's an up bar. Remember, weakness appears on these ultra high volume up bars like this. Okay, just like that. That's a great trade. The grey blocks here, Anthony, are what we call trend clusters, and they are basically built into TradeGuider to show me areas of resistance and support. Now you can see that the NASDAQ is encountering a little bit of resistance at what we call the cluster. And that is basically support and resistance lines that have been drawn in by the computer in the background, so you can't see them. And then it projects out blocks where the market could encounter some resistance or some support. I don't tend to use them on the small time frames, but they're very good on sort of 15-minute time frames. In fact, let me just remove that. What I'm going to do, just bear with me. I'm just going to come in here. I just want to make sure I haven't got any more orders in the market. Okay, let's have a quick look over here. Yes, I did get an email alert on the British pound. Let me show you what it's looking at. I'll just see if you can all see this. Okay, so we'll go here on the pound. Okay, now we can see here that the software sent me an alert because on the 15-minute chart we had sign of weakness 10 and sign of weakness 199 in a downtrend. That's the most important part. It was in a downtrend. So there we had what looked to be and what was weakness appearing. So if we go to the 15-minute chart of the British pound here, you can see what they did up here. Look, there's the weakness appearing, and they mark it down here, down to the round number. So that's where it went down. And then it looks like it wants to potentially upthrust again on this 15-minute chart. So it could actually give us another potential setup. But at the moment, I would be hesitant to take another trade there because the 5-minute chart has not really changed behavior. As you can see here, you can quite clearly see it fell down to the low here, and it's got marked back up at the moment. Actually, I probably need to roll this over as well. I haven't rolled this contract, so let me roll the contract on the chart on this one. In fact, let's go back to the other chart now. I'll just roll that over on the chart. Right, let's go and talk now about end of a rising market and no demand. Okay, and we're going to go and look at the commodities. And we're going to look at gold, which has also just had a nice setup on gold as well. It's all happening today. Look at that bar. That's definitely weak. So I think we're going to see more. All right, okay. Can everyone see the chart of gold? And we're going to start from all the way back here. And I've gone up about as far as I can go on this chart. Andrew, if I'd have gone short on the end of a rising market, I'd have just put it about 4 or 5 ticks above the end of a rising market. But the trouble is, you do get upthrusted. That's the only danger I would say with, and I'll show you it on this chart as well. The best place to short after you see the end of a rising market is actually a no demand bar. But we didn't get one in the instance on the NASDAQ. You saw how quickly that market moved. Had I been short on the signal bar, what would have happened is I'd have probably been initially stopped out. And Tom actually taught me to get straight back into the market when that actually happens. When you see the principles like this, okay, now you can see here, number 71. Now, had I shorted on there, I'd have been probably, if I had a tight stop, been stopped out on these 2 bars. That would have been a better entry, actually. After you see that, this bar here, taking out the low, would have probably been a better entry. There's a little bit of support coming in here now, and I suspect we're going to test this level in the next half an hour. But that is the signal number that we were looking for And if we go to here, you can see there's the alert, number 71, end of a rising market. I get an email in my inbox, and I haven't had any more since. So that was the last one that I had telling me there was a short trade on the NASDAQ. And there you see it. You see the result of it. So now what I'm going to do, though, I'm going to explain this to you in a little bit more detail about how we actually decide to go in and trade this. And we'll use the daily chart of gold. And we'll put up 500 bars. Okay, all right. All right, so this is gold, okay, the GC contract. It's a futures contract traded on the COMEX. Sorry, just bear with me. So what we notice here is, first of all, we're in a big downtrend in gold. Let's just get this answer phone message. Sorry, I'm in my trading office and obviously there's a message here. Just bear with me. Perfect. Okay, good. So let's start with what is the end of a rising market. Well, first and foremost, here we see back in August of 2012, the market is in a slow but steady uptrend on the daily chart. Now, what's happening is the market's being pushed up to an old area of resistance, which was at 1800, but there was no price action. I haven't got any more data going any further back than this, but there was no price action for at least 50 bars to the left. So you could have gone even further. I think it had been trending back up for about 4 or 5 months. Now, first and foremost, do we notice as the market's going up here any unusually high volume? Yes or no? Do you see any unusually high volume in this area to the left over here? You've got to compare it to all the other bars around it. Is there any high volume here? I'd say there is. I mean, let's have a look. That bar there has got very high volume compared to all the other bars around it. Okay, just bear with me a second, guys. I've got someone at the door, so it won't be a sec. All right, sorry about that, everybody. There was a delivery man banging my door down. But anyway, let's go and back and have a look at this. So you've got definitely high volume on this bar. Now, I want you to look very closely here. And what we'll do, let's put up 40 bars and go all the way back. And I'll talk you through each bar and what it means. We'll go all the way back to September. Okay, now, as we look at this a little bit more closely, let's make the volume very high. Let's ask you first of all, do you agree that that's the highest volume there for about 30, 40 bars? Do you agree with that? There's very high volume on this up bar. Absolutely massive. Yeah, it is. It was the highest volume for several weeks. Very, very high volume. Okay, that's ideally you want the volume on the end of a rising market to be even higher than that. But this still turned the price of gold, I can assure you. Now, what do you all notice about the range or the spread of that bar where the signal is, just here? What do you notice about the spread of this bar here? Yeah, it's exactly the same number as we just saw on the 5-minute NASDAQ, John. Absolutely, yes. Oh, there's no, look, there's always, look, I'm teaching you something in this session that if you find these setups, they're very, very high probability. I will never call them a sell signal, no, and I won't call them a buy signal. I will call them massive, massive supply being dumped into the market. It's been capped, absolutely. Now, that's a daily chart. Does the market change behavior after this signal? Does it change behavior? Does it change trend? Does this market change trend at that moment? It did on the NASDAQ. Yes, it did. It changed almost immediately. Here, however, there is a market maker in gold who sees that and wants to distribute some more across these bars along the top. So what happens is the market is held at that level for about a week and a half to 2 weeks. But notice, what do you all notice happens here on this bar? We go into the level of this bar, but what do you notice about this bar? And what do you specifically notice about what happens to the volume on this bar? It's much lower. This is what we call the primary phase of distribution. It's followed by no demand. But for me, I still wouldn't be short there. I mean, I know you saw me miss that trade in the NASDAQ today, and I said it was going to go down to the target level, and it did, but I never got my entry. So I traded something else where I did get an entry. But I'm sure if on a 1-minute NASDAQ chart, we'll have a look later, you probably did see a no demand entry in that down move on the NASDAQ. So now what happens to the market? Let's see when it changes behavior. So we move forward. Now we have a down bar. Now I like to look for 3 consecutive down bars after you've seen the end of a rising market. Now we can see the down bars are painted in red in this software program, and up bars are placed in blue. So over here, I actually have my first alert that actually we're changing behavior. Now the diamond trending system that's built into our software doesn't turn to red until over here, but this is where the market begins to trend down. So you can short on any up bar as long as the volume is less than the previous 2 bars. Okay, so you'll see this as the market goes down, you see it collapses. Now we come back up, look here, and what do we notice on these 2 bars? Supply entering the market, no demand at 1740. We're in a downtrend. We've got weakness in the background. That's a great place to short. That would be, well, that's actually where Tom and I went short. So it was right over here. We've got weakness in the background, sign of weakness 71. No demand, no demand. So this is a sequence that I've written about in my book. All right? 71, 198, 199, no demand. It's marking the top of a market. That is the top. Gold never went above it because professional money there have been heavily selling, not buying. But here's the trouble. The news on this day, because gold had had a rally, was that gold was again heading to $2,500 a troy ounce. But I knew that if you see the end of a rising market in an uptrend into fresh high ground on good news, then the market's weak, not strong. And we can see here what the market actually did. And if you put up 200 bars, you can see what the market did after that principle had appeared. Now, I want to talk a little bit about no demand, because no demand to many seems to confuse them when they're trying to trade it. And there's really only one place that I like to trade it, Now, we see no demand bars in uptrends and in downtrends and in sideways moving markets. So they appear in all different areas. The best place to trade no demand is after you've seen what we call a buying climax or the end of a rising market. Now, a buying climax is an equally strong signal as to the end of a rising market. It's equally as powerful, but often it will take longer for the market to change trend. So often after you see the end of a buying climax, you'll notice that the market may still go up for a few bars before it changes. So we're back on the weekly chart of gold. All right, weekly chart of gold. Notice here we've got a very high volume bar. This time the range of the bar is much wider, much wider. So the end of a rising market has a narrow range. A buying climax has a wider range on the bar, but it has the same effect on the market. It knocks it sideways, in this case for a few months before it collapses. And you can see it made a low of 1200 from where this bar filled. This was the week that gold was the safe haven. This was the week when we have one of my favorite signals in the software, SOW1. Now it says potential because we really want to make sure that we read these dialog boxes. That's what's going to help us, what helped me to learn. And first of all, it says here, describe the bar. It's an ultra high volume up bar, but it closes in the middle. It shows supply overcoming demand, and it indicates professionals are selling. In order to sell, the professionals have to unload into a rising market by selling to the herd. If they sold on down bars, prices would fall too rapidly against them. This bar should be into fresh high ground. Well, let's talk about that first. Fresh high ground. It means if I go back a couple of hundred bars, there is no price action to the left of me. So it's been in a strong uptrend. That's when this signal works best, because we've been trending up, and suddenly there's a swell in volume and the news is good, bullish. The news here has to be bullish to encourage the crowd to get excited. Now, I can tell you on this week, this is what the crowd did, the uninformed. They sold and liquidated their stock positions so the smart money could buy them, and they began to buy gold at the top. When you're a VSA expert and you're a chart reading expert, you start to act as a contrarian trader, meaning you go against the crowd. And if you go against the crowd, that is how you make money in the markets. You must be contrarian. Don't listen to all your brokers and everyone ringing you telling you gold's a safe haven. Look at the chart. If you see massive volume like this, you know there's a lot of selling going on. And there was. Some of the big banks were getting rid of their holdings of gold. Now we get confirmation of this because for a few weeks the market goes back up into the area of the climactic action. And what do we see? No demand. What does that mean? There is no buying from professional money. The volume that's coming in here is low because the professional side of the market, which move it, are not actively doing anything. So as the herd continue to buy, they withdraw their interest in higher prices. And so you have no demand at an area where there's weakness. Now, this is a place where you can short the market regardless of the trend. If you see the end of a rising market or a buying climax, and all of those descriptions and their numbers are in my book that I've given you, as soon as you see no demand at the same price level in the future, you can go short. But you must wait for the next bar to close lower. Now, again, we always read the dialog box. Now, no demand has the following criteria. Number one, it's always on an up bar. Always. So no demand is always on an up bar. Just like no supply is always on a down bar. You can get tests on up bars, but but you just don't get no supply on up bars. They're down bars. If you turn no demand upside down, you'd have no supply. Just the principle upside down. No demand works best under the following circumstances. It works best when there's a serious sign of weakness behind you, such as selling pressure, narrow spread bars, the buying climax, no demand here, again at this top. So no demand, which has got low volume, works best immediately after an ultra-high volume spike. So keep that in mind. The second place and the best place to short a no demand bar is as the market's trending down, as the market begins to fall. Okay, you get all sorts of no demand bars, but you really want to look for no demand in a falling market. And on the daily chart here, there were several. And what you want to do is draw a line from the first no demand to the second high and project it out. And you'll find into the future, the market goes back up to that line on no demand. Well, that is a high probability trade. Why? The probabilities are in your favour for the following reasons. You've got the end of a rising market in the background. You're trending down. You're making lower lows on each price bar. So we're trending down. And then each time the market attempts to rally away from these areas, it does so on low volume. And hence, you have these no demand bars, which are in a downtrend after weakness has appeared. Now, do you see no demand in an uptrend with strength in the background? You see it all the time. Is it a great place to short? No, it's not. Because very often the market will fall a couple of bars, then it will find more support because there's strength there and it'll go up again. So if you're in an uptrend, disregard no demand. It's not going to make a lot of difference. You might make a quick short trade, but really the best place to short these is after you've seen a serious sign of weakness. So far, is there any questions first on the end of a rising market or a buying climax? Any questions at all on the end of a rising market or a buying climax? Good. If there's no questions, that means I'm doing my job. Anthony says, you just need more practice. That is how I learned this stuff. Someone asked me the other day, he just read my book. He said, look, Gavin, I really haven't got a lot of time to study. How quickly could I learn VSA? What's the quickest way? And I said to him, well, hold on a minute. When you say you haven't got a lot of time to study, how long have you got? And he sort of looked at me and I said, let me give you an example. I said, if you wanted to play golf and you wanted to get the level of, say, Tiger Woods or one of the professionals, and you wanted to play with the big boys, I said, how much practice a week do you think you'd have to put in to get to that level? He said, well, I'd probably have to practice every day. I probably have to do 7 or 8 hours a day. I mean, I don't want to be a golfer. I said, no, you want to be a professional trader. You told me you want to give up your job to be a professional trader. Okay? You want the freedom that I've got and that other people have got when they become full-time traders. So you're saying that on one hand. On the other hand, you're saying you haven't got time. Which one is it? And he looked at me and said, actually, you've got a point. So I said, for me, the way I learned this and the way I picked it up was I read Tom's book, right? Not once, 10 times. I just kept reading it. I took it with me on the train. I used to go and work in the City of London. I had the book with me and I kept reading one chapter at a time and then going back over it and back over it. And then I was very blessed because I could actually go and see Tom and say, what are you talking about here? You're telling me that weakness appears on ultra-high volume up bars like this, and then the next chapter you're saying weakness appears on low volume up bars. Which one is it, Tom? And he'd say it's both. It's both. Because it is both. Here's weakness appearing on ultra-high volume, and here's weakness appearing on low volume. So he was right. And once I got that concept in my head, I thought, well, that's quite straightforward. So now what I want to talk about in the next session that we're going to do here now is how the sequences work. Because we've covered bag holding, we've covered climactic action, we've covered end of a rising market, we've covered a buying climax, and we've certainly covered no demand and where to trade that. But everything comes with a sequence. And what you saw earlier was there are certain indicators in VSA that are stronger than others. And I'm going to tell you now which ones they are, okay, which ones to look for. Now, we've already pre-programmed these into the Sierra Charts in Infinity platform, and we will be programming them into other platforms as well. Now, the signals have numbers, okay, so all the indicators has numbers. And one of the least understood of the indicators is what we call reversals, 2-bar reversals. But in fact, I'm just looking at that pound on the other chart here, that British pound trade. And it's very interesting if we look at the 1-minute chart, because what we had was an indicator here, okay, which actually stopped the short trade in its tracks. Okay, and I want to talk about this at the area here now, because I'm using a 1-minute chart, okay, to trade. I got a short trade on here, but took my profit when this bar appeared, because this bar here is a very strong indication that the market's going to reverse on you. All right. Alexander's got a question for me here. After a no demand bar, do you need to wait for a close below the low? Alexandra, if you read Tom's dialogue boxes, let's have a look at an example. Okay, well, look, that is a no demand bar, okay? But it's not confirmed, is it? Because the next bar closed higher. Okay, so we can almost disregard that, Alexander, because what we've got here is you've got a no demand bar, right? Which is the software's seen. It's an up bar. The volume's less than the previous 2 bars, but I've got strength here, not weakness now. The market has actually responded to the strength. Look at the narrow spread of the bar, and the next bar closes higher than the top of this bar. And these are called reversals, bottom reversals. Now, this number here, I'm programming these in to the sequences. So all it looks for are these reversals. And you can trade these to the long side, and we also have them to the short side. They're called top reversal and bottom reversal. All right, so you've got top reversal. Now, for those of you who've got a pen, these are the numbers that I look for to buy the market to go long. Now, in this instance, I actually didn't take a long trade because I was busy teaching you guys. But I've been testing this signal, number 57 especially, after you see ultra high volume closing in the middle like that. And very rarely does the market not respond to it. Very rarely. And you can see here, you saw that live, it pushed up. So someone said, when you're short, where do you know when to get out? When you see bars like that, because it's going to go against you. Now, it doesn't mean the market won't come back down there and retest that low. Very likely it will, because it's not acting strong at the moment, is it? So it might even give us another trade potentially to the short side to come and retest the low of the bar. But at the moment now, you know, when I say there's no trade here, we've gone white. See, all these diamonds have turned white and green. That is a no trade situation at the moment, because we're not in a trend. We've stopped the downward move and we're going into congestion. If you were to ask me which way I'd want to trade this right now, if I had to take a trade, I'd probably try and find a short trade after an upthrust. But I wouldn't actually want to be doing anything here at the moment. Now, for strength, I'm going to give you the numbers, I'm assuming all of you have got our software, but if you haven't and you want to try the Infinity charts with the VSA plugin and the scanner, as you're on this course, I'm going to let you have it for the rest of this week and absolutely no charge. If you want that, you need to email Ken, K-E-N, at tradeguider.com. And Ken, are you in the room? I don't know if you're actually in here, but I'm going to give everybody in the room a week's trial.
Yes, hi.
Hey, Ken, good to see you, buddy. You saw us make a little bit of money here, but then it sort of stopped, so I closed the position out here. But Ken's with us. He's in the room, and if you contact him, you put your email in, Ken. If anyone wants to get a copy of the Infinity platform with the data included and the plugin just email Ken and he'll get you set up. There'll be no charge for a week. After a week, if you want to keep it, contact Ken and he can take care of you. And if you go with Infinity and you keep it, they will require you to fund an account. I think it's about $2,500 US. And if you trade 10-round turns a month, then they'll let you continue with the platform at no charge. So here are the signs of strength that I look for. Right, number one, it's sign of strength 57, a 2-bar reversal. The second one is sign of strength 78, which is a bottom reversal. All of these are very strong indicators. The next one is sign of strength 79, bottom reversal. The next one, sign of strength 94, a 2-bar reversal. The next one, sign of strength 97, a bottom reversal. Now, all of these have got different numbers for a reason, but they all do the same thing. They will actually mark a turning point. Next one, sign of strength 99, a reversal over 2 bars. Next one, and the final one, sign of strength 132, a 2-bar reversal. All right, so all of those indicators are very serious signs of strength and will probably, if you're short, would tell you probably want to come out your short position. Now, to the short side of the market, meaning these next ones are signs of weakness, they're reversals which we see at the top. Okay, and let's go back and have a look at that NASDAQ. Okay, so here we can see number 58, the trap up move. Now, when you see that next to the end of a rising market, that would have been a short entry. Okay, I did not take that trade. I was too busy talking to you guys. I missed it. It would have been a setup. It would have been something. And again, someone said if you'd have been to a 1-minute chart, we would have seen clear no demand. Let's go and have a look at that and see if that's correct. NQ space pound F. We'll just put a 1-minute chart up on the NQ. It's certainly being spot. You're absolutely right. There it is. Yeah. One of our customers just said on the 1-minute chart, after you were short, there was no demand in the NASDAQ. And in fact, you can see a couple of bars here in a down move. Or both of those, actually. You've got an up thrust there. You've got no demand there. Yeah, and it's in a downtrend. This is what's causing it. There's a lot of supply on these bars. And, we saw the end of a rising market on the 5-minute chart, all right? But notice here, it was an upthrust or supply coming in, followed here by more supply coming in and then another upthrust, which I haven't talked about today because I'm focused on no demand. But here again, you can see upthrusting of the market, no demand in the market. Yeah, so this is weak. This market's weak. And it's been sold off today. And we can see here that would have been potentially entries as well. No demand in a downtrend with weakness in the background. All right. And remember, if you look at the 5-minute chart, you've got very, very clear weakness there. Very, very clear weakness. Now, you might actually see a no demand bar coming in here as the market, as they're trying to accumulate. It looks like the bears are more in control of the bulls. So if I saw no demand here, I would be quite tempted, even though there's some support here, to think about trading it. Let's have a look. Yeah, Mark's saying, what happens when you see all these clusters of green indicators here? It means they're attempting to accumulate, all right? So now they're testing it. So you've got a little bit of stopping volume down here. So again, no trade at the moment here because you have got strength, but you are in a downtrend. What tends to happen, Mark, though, when you see this type of behavior is the market will have a mini rally, okay, as they try and support it. And then you're looking to see if you get any no demand bars. But in a big downtrend like today, you really probably, especially with the end of a rising market in the background, you don't want to be buying this market. I wouldn't want to be a buyer at the moment, even though there's some strength here on this 1-minute chart. They're trying to hold it up. But what I do, if I see high volume like this, mark the bottom of the bar. If the market goes up and bounces off the bottom of that bar on low volume, then that's going to tell me then they're not interested in higher prices and they're going to mark it down further. And that wouldn't surprise me based on the fact that the Fed are pumping a load of money into the market in the next 3 days. So it wouldn't surprise me that they're going to mark it back down. So we've now got a test here. And now we've got what looks like to be no supply. No, it's a test. But if that test fails, it would be considered to be weak. There's nothing here, though, that would tell me immediately to short it, other than the fact we've been in a downtrend. So I would wait for a clear principle to appear. And on the 5-minute chart, there is some buying coming in, as you can see. So that's what you just wait to see if you go back up on no demand. And if you do that in that downtrend, then the chances are you can make a good short trade there. Because overall, we're being marked down for the day. All right, so let's go and talk then about the VSA sequences and how the sequences work. And in fact, to do this, what I'm going to do, just seeing if there's any more email alerts come in. No, actually nothing for a while, actually, which is quite interesting. Right, okay. Right, and what I'll do, let me just put a whiteboard up here. And can you all just tell me when you can see my screen again? Mark says, the biggest challenge is feeling that you've already missed 20 points and I'm sitting on my hands to keep from making an impulsive trade. You know something, Mark, that's very, very difficult for people, for an individual like me to help anyone with. It's down to your personality type. I followed some rules early on in my trading that helped me a lot. I used to trade like that. If I saw the market move, I'd suddenly rush in and then get stopped out and I'm kicking myself. And, what I learned was there's always another setup somewhere. And at the moment, I'm currently monitoring 24 different markets using 4 different time frames. And unless I get an email alert telling me there's a setup, I don't even go and try and look at the charts. So if I do miss a move, like that NASDAQ trade, I'll find another one, like in the pound, and I found one. It was a perfectly good setup. So when the markets are moving, they're all going to move at the same time very often. And so, one of the things that I learned very early on was, if you've got a clear principle and the market's taken off, let's say you're looking for a short and the market's going down and down and down and down, you're saying, come on, and you want to get in and you don't want to chase the price because, as soon as you short it on a down bar, the market pops back up and you're under pressure. So I always know at some point after a down move, there'll be a retracement move and there will be another setup. Just trust me, there will be, but it might mean 3 hours of sitting on your hands. Well, I believe that it's better to not take a trade if you're not 100% certain that the clear principle is there, because otherwise you are gambling with the market at that point. And lo and behold, strength appears on down bars. So if you're shorting into down moves and suddenly there's a shortening of the thrust and buying appears, you're going to be on the wrong side of the market. So I always try to get the clear principle. And today, one of the purposes of this mini mentorship course was the end of a rising market, to talk about that signal. Well, you don't get any better than seeing it appear live in a market and see what the market does. That should give you confidence that there will be other end of a rising market signals in other markets all this week and next week. There will be. And if you want, as I say, get the software off Ken, it will send you an email and it will tell you where that signal is, and then go and paper trade it. That's how I started, paper trading for a couple of weeks, just saying, hey, I see the end of a rising market, I'm going to be short because X, Y, Z, and there's a no demand bar. And all of a sudden, you start to build confidence. Now, what is a sequence? A sequence always starts, okay? So the first part of the sequence always starts with ultra high volume. All right, so let's draw an up bar, right? And in this instance, I'm going to talk about the upthrust because it's a great setup to trade. So you have ultra high volume, okay? The market, let's say it's been going up in the background here and up, and the volume here, it's been steadily increasing but not too high. Suddenly, you get this spike in volume and the market jumps like that. This bar here tends to catch breakout traders at these levels. And they, because the market's been going up here, they'll be getting buy signals from their technical indicators. Their MACD, their stochastic, their moving average will be giving them buy indications on that spike in volume. But we want to look at where the price closes. Now, if the price closes below the 50% part of the bar, and then this is important, this bit, and the next bar closes lower, you must infer that supply is overcoming demand at that point. Okay? So you've got supply overcoming demand here, because for the price to close in the middle on that volume must mean they're selling into the bar. Now, what very often happens is you see this, an ultra high volume bar, the market's marked up and it closes on the very low with the next bar down. That is called an upthrust and can be shorted almost immediately you see it. Now, the upthrust, the most popular one that I see, if that's the right word for it, or the one that we see the most of, is SOW10, sign of weakness 10. All right. Now, it always will come on, well, always. It usually should come on ultra high volume. It is a clear indication that the market is weak at that time. Now, again, if we look at the NASDAQ today and we look at what happened this morning, we can see on the, I think it was the 1 minute chart, was it? I saw it. You got a very clear upthrust. There, that's it, right there, look. Okay, so here's your weakness coming in. There's supply coming into the market, okay? That's selling coming in. We can see what the selling's done, look. It's just completely knocked this market down to the round number, to 3200. So it completely took out my target of 3212, and it's just gone through it. But that's because of the supply that's present here. Now, we look at this bar here. The software sees it as number 128, but I would call that what we call a hidden upthrust. Look at the volume on it and look at what happens to the market. Okay, here, professional money are dumping into the market. And on the 5 minute chart, we saw in this 5 minute period, the end of a rising market on a bigger time frame. So what was happening was basically the selling was swamping any demand at that level and causing the price to fall fairly rapidly. Let me just get rid of these trend clusters. And so we've now taken out the low of this bar. And have we had any no demand bars here that we could have shorted on this time frame? I don't really see any. And sometimes that happens. In fact, you've got a little bit of weakness on this bar here at the moment, but it has had such a big down move that any shorts instigated around this round number could go through it, but you're vulnerable to some buying coming in. But at the moment, this market does look weak. There's no doubt about it. It looks weak, and the end of a rising market signal has been a very strong sell-off today in this NASDAQ market. Now, I haven't looked at the S&P yet at all, but let's go and have a look and see what the S&P looked like, because I know that this level at 1690 was going to be a crucial area to come down to. And in fact, we've now got what looks like a selling climax. So this is going to be a very good chart to examine. So what have we got? Well, over here, you've got a sequence that is in place. All right. Now, this bar here, and this bar here is what we call a sequence. And what makes the sequence powerful is the volume on this upthrust. Now, the first part of the number of the sequence is number 26. Now, that is actually very, very common. sign of weakness 26 is seen very, very, very often in the software. And it tells us that the market here is having some supply hit it, some selling hitting it. Okay, and Anthony was asking, what is the purposes of these colours in this volume histogram at the bottom? Simply put, to Anthony, when you get very high volume, it hits this salmon coloured area. It tells me that there's some unusual or ultra high volume coming into the market. Now, we can see here that the number of contracts that were traded up at that price was 5969, and now, just over here, 56,404. So both of those volume bars are pretty significant, as we can see. Now, we've got a lot. So when we see it in the salmon-coloured area, it tells you it's ultra-high volume. When we see it going into this lower band, these two lower bands, it tells you that the volume is now low into that area. And in fact, here we can see the blue line is the moving average of the volume. It's averaged over several bars. So at the moment, we're at below average volume, apart from 15 minutes ago, where we had the climactic bar. Now, if this market's going to recover and go back up, I wouldn't even think about going long until the top of that bar was taken out. And I'll show you why. This line is going to prove to me if this is genuine buying or just an effort to hold the market up. If you see no demand bars here, then it's going to confirm that the market is still weak and could fall further. We've had, though, such a big move for a Monday when you don't usually see the market move 17 points in one session, but here we've seen it because of the upthrust. Now, the upthrust here is after you've seen the weakness appear, we use effort versus result. Now, look at the effort in that bar. Okay, look at the volume in that bar. But look at the result and look at where the next price closed. That is a sign of weakness. It's not strong. It's a serious, serious sign of weakness. A couple of questions coming in. Mike says, if the sign of weakness closed near the low or down, would that be really good selling sign? Yes. I mean, in this instance, you usually find SOW26 happens and it closes up near the high. But this one confirmed it. This was the real sign of weakness. But what we then had was capitulation in the market. That signal's quite rare, number 78. If you see it, it's weak. Now, Mark was saying, but that's the US Open. I don't care whether it's the Chinese Open, the Asian Open, or whatever. If that volume comes in on the Open and it's an upthrust, and you've got end of a rising market, which we saw on the NASDAQ, the market's weak. They're selling at the Open. We always get the biggest volume at the Open because that's when most traders put their positions on. But again, you can see a weakness in this market at the moment. There's just no strength here at all. It's not finding any key support at the moment at all, which is good, which is a good sign, which means they're marking this down potentially for buying. Because when we see a markdown like this in a bull market, it's a bullish sign. Yes, you can make money short all day here, but don't be surprised to see shakeouts now and testing of this level. 1690 is quite a key level for the S&P. But don't be put off by seeing ultra high volume and just saying, oh, well, that's the US Open. It always does that. Look at where the traders have positioned themselves today. Okay, clearly they don't want to see any higher prices. And the only reason they don't want to push the price up against themselves at the moment is they want to buy on down bars. So what sort of signals would I be looking for now down here? I'd be looking for bag holding. I'd be looking for shakeouts. I'd be looking for climactic action. And those are the type of signals I'd be looking for to see if they're going to reaccumulate at this lower price. Great. Thanks, William. He says the low-cost mini mentorship courses in real time are great. I prefer doing stuff in real time because it's much easier to take some trades, show you some setups. One of the things about the end of a rising market signal is you don't see it very, very often. But this morning, we did see it in this mini mentorship course, which was all about that signal. And forget the fact that I missed the trade. Go and trust the signal, because it is an extremely strong sign of weakness when we see it. And it's extremely strong if it's followed by no demand. Okay, now I'm being told to go and look at some currencies where some principles have appeared there. So let's go and have a look at the Aussie dollar. Now, again, we'll start with a 15-minute chart. Now, again, we were looking to see if this was going to break out. Now, we did have some strength on this bar here. Yeah, there it is. That's pretty obvious. So, again, strength appears on down bars. Remember that? It appears on down bars. Do you all agree that's what I call a Yao Ming bar, okay? It's a markdown on massive volume, and we've actually sprung that area and caused an up move. So that means that any pullback now into this area could be a trade set up to the long side on the Aussie dollar. So what we've got here today is we're actually springing this stopping volume. Okay, it's pretty climactic as well. Here's what I was saying earlier. They dipped the price down just below, look at the open. Support comes in, and we're in an uptrend at the moment on the Aussie dollar, which is quite interesting. Now, let's have a look at what the next bar is going to tell us. We've encountered a bit of resistance up here. There's no demand in an uptrend. It did knock the market down. There's no doubt about that. So there is some resistance because of this bar here. So that's what's causing the resistance to upward price. Go to the 5-minute chart. Now things look slightly different here. Now, what have we got? We've encountered a clear resistance top. Okay, now Grigory, my colleague in Russia, was looking to see if he could catch a breakout trade on this Aussie dollar, looking for it to break this clear resistance line. Well, we're trying it right now. So we're going to see, we've actually got a test here, which happened about a few minutes ago, and they're actually trying to break this out. So let's have a quick look here. It's in a nice slow uptrend, and in fact you can draw a trend channel or a trend line on this, fairly convincing one from the low here to the secondary low, and you can actually put a nice trend channel on here and see where we're at. You've also got a clear resistance line, and it's encountered a hell of a lot of resistance there. I wouldn't like to be trying to catch the breakout of this myself. I'd wait. Anthony says, do the minute charts have more signals than a daily chart? Yes. I mean, this is a 5-minute chart, as you can see, Anthony. And actually, yeah, if you use small time frames, you get a lot of indicators, absolutely. But remember, you're looking for the key ones, all right? And the key ones that make the money, end of a rising market, bag holding, 2-bar reversals. Those are the things that are going to change the trend of the market, as we saw today. Those are the ones you want to look out for. Then, for confirmation of those signals, if it's weakness appearing, meaning end of a rising market, look for no demand, which we saw on the 1-minute chart of the Aussie dollar. And then if it's strength, you look for no supply. So if you see bag holding, and then a few bars later you see no supply, that's a really strong VSA setup. Very strong indeed. And that's exactly what these email alerts are for. You don't have to go and search hundreds and hundreds of charts trying to find one principle, because it's pre-programmed in. I don't think some people realize the value of that. It's very, very valuable. And if you're selective about your trades, if you only say, I'm only going to trade the end of a rising market and bag holding, and just try it for a month, and you test your results, I think you'll be very surprised. And I know that because we've got customers that are doing it. So looking at this, Grigory, it looks like it wants to push higher. I would agree with you, but it's encountering a lot of resistance at the moment. Now here, for me, there's no trade setup because we've got resistance. We're encountering a lot of choppiness in this area on the Aussie, as you can see. And if it breaks out, then maybe I'll be interested in buying the first test. But at the moment, I wouldn't say that is high probability. Okay, and Gregory agrees with me on that one. So let's go and have a look at the pound, where I've already made my money today. Now, we did see, remember, strength coming into the pound. Here it was, stopping volume. And I traded the down move, as we saw earlier, using the smaller time frame. And then on the 1 minute chart, is this likely to go very much higher? Well, you can see where the strength came in down here. And it's continued to drift up. There's a little bit of testing. Nothing to write home about. Again, now it's had its decent move. It's going into congestion prior to lunchtime. So you've got lunchtime coming up in America. Phil, I'll be finished in about half an hour. Yeah, I just want to go and show you these principles live. That end of a rising market, well, it's a classic, isn't it? I mean, you're doing a webinar or a training session on that signal. The chances of seeing it on the day that we're doing the session, even though I didn't trade it, and I look back on that, I should have been short there. I have to be completely frank with you. If I wasn't busy teaching, I would have shorted that. It was a good opportunity, and I'm not saying that with the benefit of hindsight. It's a good signal. It really is, and you'll have confidence in it. Gregory, I do seem to be having a few strokes of luck on these live trading sessions. Now, the next one I want to do, by the way, is doing a live trading session where we all trade together live, and actually we'll do that next week when the Fed release their money on the 30th of September. So I will do another one of these, but it'll be all live. We won't be using any PowerPoints at all. Someone said the yen. Okay, let's have a look. I haven't looked at the yen recently. I know it's had some. I'm going to start with the biggest time frame first. There's nothing particularly obvious on the yen other than you've got a little bit. I see what you're saying. Yeah. There's a little bit of weakness on this bar here. Yeah, and it is going back up there, and there is some supply on that bar. It's worth looking at on the shorter time frame. We'll do the hourly chart. I see what you mean. Right. Okay. I had an email from a customer, and in the email he was saying, if that isn't Yao Ming on the yen, he'll eat his hat. It is. That's a very weak bar. Now, it is interesting where we're back up to. We're up to the low of this bar on the hourly chart. Now, let's delete that, and let's get rid of the trend clusters. So the low of this bar here is where we're hitting a little bit of resistance at the moment. I would not be short yet on this chart because it is trying to push up, but I would be short if I saw no demand up here at 102. I would be inclined then. There's a lot of supply in that chart. Definitely a lot of supply hitting the. Andrew says the FTSE on a 5-minute bar has just had sign of strength 129. I don't think I've got FTSE data on here. Let me just check. I used to have in eSignal. Andrew, what's the symbol in eSignal for the FTSE? What's the symbol? I'll just see if I've got the data on here. I know I subscribe to it. What's the eSignal symbol on the FTSE? I've forgotten what it is. I did have it at one point. Just having a quick look. Oh, it's Metastock. Okay. All right, let's have a look at the euro then. This one I would consider shorting. This I would probably consider shorting because it does actually look very, very weak at the moment. There's a gotcha bar here. Just bear with me a sec. I may well have a trade and just get an order put in here. This one looks more interesting than the others at the moment. This could be a short trade on the euro. Let's just put... Okay, let's just put that order in. Now, this one is slightly more interesting. And let me show you why. Okay. All right, so I'm paying attention to this widespread down bar, and then this up thrust, and then you've got a no demand bar. Now, the first thing is, are we in a downtrend here? Yes, we are. Okay, clearly, from this top here to this top here, we're in a downtrend. All right, there's no doubt about that. So from that level there to that level there, we're in a nice... That's not a very good trend. Let's just get rid of this trend clusters. Okay. So here we'll put the trend channel on. Let's go from this high here to that high just there. That should give me a good channel. Yeah, and we've broken out through the channel here. So that's not a bad channel. Okay, it's a 5-minute chart. All right, now here you can see we've got an upthrust in the background, all right, in this downtrend. So that's actually in the right place, as we can see. Now, if we mark the closing price of the upthrust bar, that's going to give us a good place at the top of that upthrust to put a stop there, just on the top there. Okay, let's put the red line in there. All right, and let's watch to see if we break the low of this this trend channel. So I can see there that what I'm looking to do is to retest this area here at 482. So only 10 ticks. And if I use the 1-minute chart, see if there's anything. This is just flatlining at the moment, but that often does that. But here's your weakness, look, and here's your area of support. But there's the big weak bar there. Look, that's where the supply hit. It's just knocked this market sideways. So that's going to want to, for sure, I think, try to push a little lower. But there is a lot of supply present, and then as the markets come back up to that level, look, you've got a lovely trap up move, immediately followed here by no demand right here, and the market has responded negatively here, negatively here. There's more no demand on the 1-minute chart. So you've got weakness in the background here on the 1-minute chart. And you've got an area where the market probably wants to come down and retest. These are only 1-minute bars, but they're not strong. There's no strength in them. You know, once it takes out the low of 1390, well, 1.3490, then I suspect we'll see lower prices. But this has got supply in the background for sure. Okay, and we'll have a quick look at gold while we let that trade develop there in the euro. See if anything happens. Let's have a look at gold quickly. I haven't looked at gold today. Yep, there is a signal there. Yeah, that's an upthrust. It's on a 1-minute chart of gold. You've certainly got weakness in the background. The only thing I'm a bit concerned about, you've got some support underneath us here. Yeah, but we'll see if we get a no demand bar here on gold. The reason I want to use the 1-minute chart is just the principles come quite quickly and they're quite good to explain. Yeah, that's an upthrust of this area here. Yeah, let's just see if I can get an order in on gold as well. Okay, let's see if that reacts. All right, so I'm going to use a 5-minute chart here on gold and a 3-minute chart just to see. Yeah, it's a bit counter-trend trade. That's the only trouble that I have with this, is it's gold's trying to push up at the moment. And there is some strength in the background here. We'll see. It may push down a little bit. Let's put the euro up next to it. And we'll just see if this comes. Right, so here we see it. So they're just testing this level at the moment. And let's just put the euro up. And it's quite interesting watching the two together. So gold really not doing anything much other than sort of just drifting up. And the euro, I'm just seeing if we get a no demand bar here. So this is what I'm watching here, is the euro really is the main one where I can see a potential setup here. Notice that I've marked the low of this bar. See, it's gone up on no demand. It's rejected it once. It's rejected it twice. And we've got 50 seconds for this bar to close. Now let's have a look at the volume. The volume on this is, yeah, it's pretty low. So it's not going to be a no demand bar here. Yeah, it's gone a bit quiet. Yeah, that happens sometimes. After a big move like that, sometimes the market pauses for breath before it takes another leg down. So this actually produces an email alert here on these two bars, because you've got here this upthrust, all right? So it's in a downtrend, so it's in the right place, and it's followed by no demand bar. So again, in a downtrending market, that's just telling me at the moment that market is weak. By the way, is there any questions on no demand at all? No demand. Gregory's asking, why haven't I marked this bar here, which has got the highest volume on it, and the high of that bar? You could do. There's nothing wrong with that at all. It's just I'm looking at where the market's traded at. But you could absolutely mark that, Gregory, because you've got here. All right. And then down here, where the gotcha bar is, you can see that's where I'm expecting them to test at 3482. So about 12 ticks down. So that's where I'm looking for this market to go, to retest that level, hopefully on lower volume. But if it takes out that level, it could run. We could have a runner. But I don't think so. I think initially that's perfectly, it's certainly not acting strong, but it's not going anywhere at the moment. So I need to see an increase in volume and a breakdown through this support level here. That's what we're looking for. Yeah, it's a bit like pulling teeth watching this one at the moment. I want to show you a clear no demand principle, but there's one there definitely. I mean, that's a very good principle with this in the background. The market is failing to respond at that price level, but it's also not, it's stopping at 3493. So we want to see that break down a bit lower. Okay, and gold is coming down now apparently. Yep. Yeah, there's no demand on the 5-minute chart there. But you know something, Andrew, for me, this is trending up still. I wouldn't short that personally because it's up. Bill says, if you see a test and it's on high volume, would you reasonably expect to see another test? Absolutely. Very, 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 very often, if you see a high volume test, you will see it retested in the future. Very often, Bill. Absolutely. Very often they'll do that. No, just looking at all these markets at the moment, I mean, we've had our big move in the NASDAQ this morning, as we can see, and it's actually recovered. Remember I told you about 2-bar reversals and stuff? Well, they've tested the market here, as you can see, and it's just holding its level, but it's not going up on very high volume. So there would be nothing there to trade that I could see. But yes, definitely the end of a rising market this morning was the highlight of the day here. And, we didn't get any no demand bars as it fell, but it's fallen so much that you'd be taking a big risk trying to short it at the bottom here. Yeah, AJ, my trading plan, which I can show you all, will be coming out in an email to you when we finish here in about 20 minutes. We'll send it out in an email. Okay, and then if there's any questions about the plan at all, it's pretty self-explanatory, the trading plan. It's got all the time frames, it's got everything. Yeah, you can see how it's responding to that. Yeah. Okay, so here comes the increase in volume, and we're making a new tick low here, which is good to see. Yep, certainly. I'll be happy to analyse crude. Absolutely. Okay, I just want to check my trade here. Okay, that's good. Right, let's go and have a quick look at crude oil then. Haven't looked at that for a little while. And let's look at the hourly of crude. Well, it's definitely accumulating. There's definitely some support here. You've got a shakeout down here on the crude. So you've got climatic action, narrowing of the spread. So based on that, I think we're going to see, if you see a test along here, then we could see higher prices in crude. Yeah, the 6E and the Nasdaq and that, I think it could well be testing. And if it doesn't break that low shortly, Gregory, I'll just close out and wait for another opportunity. But crude oil actually looks like it's accumulating. From what I can see here, there's accumulation happening here in this down move, which has been tested here. There's no supply, look, and crude's trying to pop up. Nothing obvious, I would say, on the 15-minute chart. But yes, here, stopping volume, test, another test, another test. It's just flatlining. Wouldn't really want to be in a trade on crude at the moment, personally. I'm just going to go and see if there's any email alerts that's come in. So just bear with me, and we'll have a quick look. So that's what the euro's done, pretty much nothing at the moment. What's the time now? It's midday. Yeah, sometimes that happens. Right, let's check the email alert service. One just come in now, earlier on. The Japanese yen. Would you believe it? We were looking at that earlier. 6J. Yeah, here it is. That is a sequence right here. There's your supply. There's no demand. There was the upthrust. Okay, so that was a short sequence. And we know we've got that weakness in the background. So that's a potential setup now if we see no demand. So let's put the yen up with the euro. Okay, so let's see if we can get a setup here on the yen. Well, I've got 30 seconds for this bar to close. Just open the window in here. The bonds are looking quite interesting as well, just looking at this. John's asking, what is the highest probability sequence to short? Well, I think you saw it today. It's the end of a rising market followed by a reversal. That's probably as high as they get. Now here, on this bar, you see these two bars here. We want to see if we get any no demand up at that level. Let's get rid of that. So you've got a lot of weakness above you. Market's knocked down. Now it's going up. I'd love to show you a principle live. That would be good. Okay, so this is looking quite interesting. Let's get the contract up here. All right, so we'll be very interested to see where this bar closes. Yeah, Mike, I'm trading the currency futures contract. I'm not trading the spot Forex. If you're on MT4, you'll be trading spot. I'm actually looking at the currency futures contract. Okay, Grigory in Russia is trading it in Forex. Okay, so this closes in a few seconds. We'll see what it says. Well, that is an upthrust on very, very light volume. And certainly where we're at, the only problem I've got is it's counter trend. So this would not be what I call high probability at the moment because it's against the trend. I really would like to see more evidence. Let's wait to see if this next bar closes a bit lower. But that is definitely a principle there. But it's against this trend of price. And even though you've got a lot of volume on these bars, that's still counter trend trading if I short that. So I'm just going to be a bit more patient with that one. Yeah, Andrew, there's some stuff going out tomorrow for the UK. We just started the service today. So the stock alert service, we're going to do a scan, and there'll be some alerts going out for that and Australia tomorrow. Yeah, that's a very good example of an upthrust right there. And it's knocked the market down, but it's not responding yet. Now, that upthrust there is on very low volume, but the market has not yet shown me any sort of change in behaviour. So at the moment, it's still actually trying to push up. So that's why I'm more cautious with an upthrust like that. If that was on ultra high volume into this area, then maybe I would think about, hey, they're forming a top up here. But we don't know. We know there's weakness in the background, though, on the yen. That's why I'm following it. We know there's weakness in the background. Looks like I'm going to have to scratch my euro trade altogether. There's nothing going on with that euro at all. It's just drifting sideways. Yeah, there is a bit of no demand on the 5 minute. But yeah, but so this next bar would have to close lower. Should an upthrust always be on high volume? It's preferable to have it on high volume, yes. Yeah, I mean, I'm just reading these bars at the moment, and this has gone up into this area here, and there's very no volume on it, which would indicate there's not a lot of interest there at the moment. But remember, Bill, we are trading again. This is the trend of price. It's going up. So if I do short here, I may get some money on it, but it's more risky than some of the trades I like to take. I like to take the trades. So I'm not in the market at the moment here on this yen yet. Okay, while we're watching this, because we've got about another 5 minutes left, is there any questions at all on what we've covered today? I am going to send you a copy of my trading plan, and you've all got a copy of my second book. And for those of you that want a copy of the Infinity platform that I was using earlier with the scanners, you can have that for a whole week till next Monday, free. We can get you a free download, and we'll set you up with the indicators. You just need to email Ken, K-E-N, at tradeguider.com, and he'll assist you. Okay, Bill, that's fine. Gold, any idea where it might end by the end of the month? Okay, I have got some ideas on gold. The way it's currently looking and the way gold's currently set up is we've got a lot of supply in the market, which is being tested, as you can tell. Now here, I would be very surprised if we don't come and retest 1300 at least this week. So I'm expecting lower prices in gold, not higher prices, because of that supply that's present there. But so yeah, I'm not bullish by any means on gold. I still think it can come down, but they could have an upthrust here up to 1400, where the other weakness was. So at the moment, I can't really do anything on it until I start to see what today's bars tell me. Usually you get a clear idea on what they're going to do with gold for the week on a Monday and a Tuesday. You get your clear ideas, and then we send our alerts out just after that. Yeah, so the euro scratch now. Yeah, okay, so the euro was a scratch there. I didn't want to leave that running. It just didn't do anything. So let's go and have a look then at where we think gold's going to go. Well, I mean, look at the overall trend first of all. We are trending down. We have got spikes in volume to the upside. This is a 4-hour chart, so we've got a nice mushroom top, which is what I like to look for. Okay, so you've got a very nice mushroom at the top here. Here's your Federal Reserve announcement. The market's come into the body of this bar now. Any no demand bar here or at this level, I think would be a good short trade. That's what I'm going to be watching out for this week, for certain. And that's what the trading alert service, that's what we're going to be alerting people to. The euro has support with high volume, says Mike. We'll look out for low volume tests, okay. My favourite sign of weakness is definitely a buying climax and the end of a rising market, Chris, by far. By far. You saw today live the end of a rising market. You can't argue with it. It's a live signal. It's a very powerful signal. If you just learn that, you'll do very well. I like the upthrust as well, though. Upthrusting the market is a good place to short as well. Anthony's saying on Monday, when the Fed releases the money, would you expect gold to surge and the dollar to fall? Possibly. I think the gold could have an upthrust, but I still think it's weak, Anthony, overall. And again, I try not to be too predictive about what I think. I try to trade what I see. If I see something like the upthrust in the pound this morning was an obvious one. So I try to trade what I see, and I don't trade into federal announcements because the market's too volatile. You can lose a lot of money if you're on the wrong side of that market. I will do another one of these mentorship courses here, the mini mentorships, probably in a couple of weeks. I might try and do one actually trading into the federal announcement. That's going to be quite a good one to do as well. Good. All right. Is there any questions, everybody? If not, as I said, contact Ken, Ken at tradeguider.com. If you want to get set up with the software, you can have that for a week, no charge at all. And we'll send you an email out to all of you with a copy of the recording. It'll take a few hours just to update it, and then you'll also get a copy of my trading plan, which you can take a look at as well. Good. I hope you've all enjoyed it. As I say, we've covered quite a lot of ground there today. We got a perfect situation. Let's just go and recap. On the NASDAQ this morning, we were talking about the end of a rising market, and you saw it live. It came in. You saw the result of the end of a rising market. And really, I have to say, when you see signals like this appearing, you know that professional money must be selling into that move. And you can see what the NASDAQ has done on that. Yeah, so it's very, 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 very interesting. And you can see what the market's actually done on that signal. So have faith in them. Bag holding, end of a rising market. When you see them, watch what the market does. You'll be very surprised if it carries on going up after you see that signal. And that's only a 5-minute chart. And look what it did to the market today. It knocked the NASDAQ down nearly 40 points. That's a significant move. And although we weren't doing live trading today, I did manage to trade the pound. And I also traded the euro, but I scratched that trade at the end because it's just not working. It's just popping. It's not making a move. Oh, it's up thrusting now. Someone just said it's an up thrust. It's exactly well, typical. Now I've got to get short again, probably. There you go. That is an up thrust. Definitely. Let's have a quick look. Let's go back to my trading ladder. That's quite funny. Yeah, that's exactly what the up thrust is meant to do. All right, let's get back in and have a look here. Just watch to see if that up thrust is enough to move the price down. But that's an up thrust. That's done deliberately there. So now you've seen sign of weakness 10, the up thrust. So now we look to see what they up thrusted this top here. That's right. Yeah. So that's done deliberately. So it basically went along here. Nothing much happened. Then there's the volume. They up thrust it. Now we'll look for no demand and see if the market falls away. But that's quite classic to see that right at the end there. Brilliant. Mike says, do you pay any attention to the first H1 bar at the start of the trading day? No. I just look basically at what the volume's telling me. And I often know they're positioning themselves, Mike, at the opening, the first 15, 20 minutes, they'll wrong foot you very often. And, like they mark the price up like they did today. And everyone was caught with a breakout trade. Trade guide says, end of a rising market, market falls. So that's what happens. All right, everyone. Thanks ever so much. I hope you've enjoyed it. God bless. Have a great rest of your trading week. I'll be back with you. We'll probably do another one of these courses in a week or two's time. I hope you've enjoyed it today. I'll send you a copy of the trading plan and the recorded archive, and we'll have that out to you in the next 4 or 5 hours. So all the best to you. Take care, and I hope you learned some principles today that will make you money in the markets. Take care, everyone. Bye-bye.
The organizer had